I'm Sabnet Ahuja. I jointly with GH2 developed a program called CETFi, which stands for Climate and Energy Transition Finance Initiative. And really the purpose of this program was to look at predominantly macro issues on financing, not micro issues, not project, or rather not centric on just the project alone, but looking at macro issues on how do we mobilize large-scale, non-recourse, long-term concessionary finance for climate and energy transition. And of course, finance is a function of a number of factors, both availability and the cost of finance. And we during the program, when we kickstarted the initiative back in September last year, we looked at a number of aspects, which I will talk about during the presentation this morning. But the reason why we are here today is also a soft launch of our report on this very subject. It's designed as a continuous evolving working paper rather than a snapshot in time, because if we are to mobilize hundreds of billions of dollars, it can never be a snapshot in time. It has to be a financing continuum that one has to evolve. So I'll take you through the sort of salient points that have been identified, the inputs provided into this particular report have been tremendous. More than 200 people contributed in some shape or form, all experts in their respective fields from different dimensions, whether it's policy, legal aspects, risk management, of course, the banking and finance industry, the developer community, and civil society. Everyone contributed to this particular body of work. So with that, if you indulge me in for the next 10 to 15 minutes, and I'll take you through okay. So during the G20, Mr. Amitabh Kant, India's G20 Sherpa, put out this very statement that the developing world will need about almost $6 trillion if it has to meet its obligations or its targets. And over and above that, we need significant capital investment going into developing and accelerating technologies. Where is this money coming from? Right? That is the big fundamental question. So with that as this statement as a backdrop, we started to look at what are the fundamental issues that one has to address. And right at the top is not just policy in its intent. It's policy followed through by building confidence in the market through a market-making structure, right? And by that, I give you an example. Let's look at a lot of the performance-linked incentives that Indian governments come out with. Let's look at the US Inflation Reduction Act. A lot of these policy drivers are, very, very bold, very, very ambitious, and positive in their intent. But the follow through, if you take the green hydrogen sector, the follow through is, yes, there's a lot of buzz, but are the projects getting financed, right? Are long-term offtakes being signed? And the answer is no, right? Projects are being developed, designed, but they're not reaching their financial closures because every lender is asking this one very question: who's giving you a long-term offtake, right? And that's a function of price predominantly. So how does one kind of get out of this kind of deadlock of not having a well-defined kind of structure. So right at the top, what we say is let's look at a number of critical issues. And for us, issue number one is the risk profile of both the nation and the sector. Right? Um, if we don't identify risk, and most importantly, if we don't quantify risks, we are not going to be able to price risks. If we are not being able to price risks, we can't finance those projects. Right? So we did an extensive exercise where we looked at risk in two sort of big buckets: what are value chain, which are within the sector, within the segment, and the number of projects and project nodes along the value chain, and what are systemic risks. Right? Systemic risks are common to all. What's the borrowing rate? What's the country sovereign rating, which affects the pricing, global volatility, whether it's geopolitical risks or global inflation, which affects cost of money, are some of the challenges that we looked at. So if more than 50 such individual risks were identified, both in value chain as well as in the ecosystem. And each of these risks is, as I said, a function of the segment that we are dealing in. So if you're dealing in green hydrogen, one would look at where's the renewable energy capacity that has to be paired with green hydrogen. So we know that you cannot displace existing RE power. So is the RE power coming online in sync with the ambitions of the the green hydrogen sector? Where's the transport? Where's the storage and all of those aspects, right? If you look at EV charging or electric vehicles, where's the grid infrastructure? Is grid infrastructure coming online at the same time as the rollout of EVs? If you talk to all the national grid companies anywhere in the world, they will say, let's take this particular area where we're sitting in Mumbai. If every vehicle in this area was an EV and they all plugged into the grid at the same time, the grid would follow. And that's true for every city, every country in the world. So the projections that are being made on EV, are they sort of pairing up with the infrastructure, right? So that's a systemic risk. Just an extension on EV, speaking to a lot of the insurance companies, they have started to not yet in India, but elsewhere in the world, many insurance companies are walking away from insuring electric vehicles. Why? Because the slightest damage to the car battery, the entire vehicle has to be written off, right? So the servicing and maintenance infrastructure and capacity is not coming online at the same time, right? So there's so many systemic risks, value chain risks, and one has to develop these for the very sector within the very market. Moving on, what are systemic risks, right? So once we've looked at the value chain risks, we look at what are the systemic risks. So again, you look at policy for that particular sector. Sometimes policy is larger than the sector itself. But I would say the most important aspect when it comes to new approaches to climate finance is the credit supply in the country. Right? So if India has to meet its 2030 ambition on any of the renewable energy segment, right, we need more between anywhere that the estimates are between $600 billion to $1 trillion of capital spend. Right? If you talk to every banker in the room or outside, the answer is, oh, there's enough money for good projects, right? Now define a good project. Again, we go back to, is there a long-term offtake agreement available? And the answer is no. So no, there is not enough money because there are not enough projects. And if there were enough projects, there will not be enough money. So how do we get more credit supply into the country at price points which makes the project viable and bankable. Right? So we looked at a number of these risks. So as one of the programmatic outputs is developing a national risk register, right? So we already started building that. You saw a little glimpse of the national risk register, and this risk register will help all the stakeholders in the system to be able to understand the risks and price them. And one submission and suggestion that came out is we need to engage the rating agencies better, right? Because rating agencies are not giving the same value to the projects because of their lack of understanding of the risks of what I call the new energy economy. Then, as I said, our most important recommendation is developing a market maker. So the role that SECI and NTPC played during the development of the renewable energy sector, which is giving that long-term bankable offtake agreement, right, is the function that one has to look at in pretty much all the new energy economy and climate finance. And hydrogen, or rather green hydrogen, could not be a more apt sector to implement this. There are my colleague Rolf, who joins us from Germany, will talk a little bit more about this, how Germany and EU both develop their hydrogen market makers. And what is the role and function of a market maker? Essentially, in absence of 10-year plus offtake agreements available from the end consumer, whether they're from ammonia, transport, steel, refinery, whichever sector is a consumer of green hydrogen, they're not giving 10-year plus offtakes yet. So in absence of that, how do you then jumpstart them? It'll be a chicken and egg situation. So the role of the market maker is not just being an aggregator. It has to absorb 3 different categories of risks. So one is pricing risk. So the market maker commits to a price to a developer, and if it's not able to find the same pricing on the end consumption side, then it has to bear that risk. The volume risk, it commits to, let's say, 100,000 tons, but the volume offtake is more than 100,000 or less than 100,000 available. It cannot match the volume. And tenor risk, which is matching both the production side, tenors of production side, as well as the offtake side. So these are the risks it has to assume. Just mere role of aggregation will not suffice. Right? So this has to be, market maker has to be backed with a balance sheet, given a credit rating, so it is able to assume those risks. Now, its goal, of course, aggregation is one key aspect, but its main goal is to reduce the price differential between green and gray. So how do you do that? There's a construct called CFDs, contracts for difference. Now that contract for difference, so if the production cost is at, let's say, $3 a kilo, and purchase price is $2.50 a kilo, so that 50-cent differential it has to bridge. There's government subsidies available, there is grant monies available, there is, of course, carbon finance, if and when it is available, right, is the question. So somewhere, someone has to play the role of reducing this gap, right? And that's the function of essentially the market maker. So moving swiftly on from building that confidence, which is understanding of risks and creating market making structures, you look at, is there the money in the system, right? And I'm not talking, when we spoke to a lot of the bankers are saying, as I said, there's money for good projects, but assuming the projects are all good, then is there enough capital? Right? So we are targeting 10 gigawatt to a 50 gigawatt per annum deployment, which means 5 times the money in the system? Is there availability of that kind of money in the system, which is what we look at, wholesale finance, and not just project finance. And for that, one looks at what is my financing continuum, right? So is there enough development money? Are developers able to sell their projects and move on to an operation and maintenance mode, and redeploy the equity that they've unlocked? Is there enough project finance available in the system? Are banks able to churn that capital, right? And how do banks do? They downsell their debt books via bond structures and others. So is there enough money in the system? The fact that India is now included in the emerging markets index will mean that significant liquidity will start to come in, hopefully from this year onwards. And then finally, are we able to unlock institutional money? Institutional money is the biggest pool of capital globally. We've developed structures like REITs and InvITs to bring that institutional money. There's 1.5 trillion alone available in the Indian institutional markets. But there are structural barriers to why that money is not coming in, because the projects have to be AAA rated, right? Investment grade. And that's where I bring back the concept of rating agencies. So why are rating agencies not giving that kind of rating? If banks are lending to the projects, but rating agencies are not looking at giving that kind of rating. So assuming, again, if we have addressed that particular problem, and going back to the original slide where Mr. Amitabh Kant says, where is the 4 trillion, 5 trillion coming from? The global institutional markets are more than 100 trillion under management. So why does that money, why can't we attract that, or enough of that? We are attracting that money, but not enough of that. And the answer is we don't have enough conduits yet. I know Gift City and other locations have started to put more and more InvITs online on the exchanges, but there's still a perception bias, right? That India is more risky. So why can't we also look at putting those vehicles on New York Stock Exchange and London Stock Exchange and Singapore Stock Exchange, where many of the asset managers in the world, in their charter, they cannot invest outside OECD countries, right? It's in their charter. So as much as they want to invest in India or other emerging markets, they can't do so in their charter. But that should not stop us from being able to tap that money. It's no different than somebody buying into a BP or a Shell stock, which is trading on the top exchanges, but the underlying assets are anywhere in the world. So same way we list these vehicles, which are called yieldcos or yielding companies, to match the asset liability curve and profile that institutional investors want. So those are the sort of aspects we look at on the institutional finance. And then another thing that came up is foreign exchange hedging, right? As rupee depreciates, right? You look at the last 30 years of rupee's curve, it's on an average depreciating 5% per annum. It may slow down in certain quarters or years, but if you average it out, right, which means your levelized cost of energy, levelized cost of hydrogen, that's flat over the tenor of the project, 15, 20, 25 years, you're paying in rupees. So every dollar that comes in then is depreciating 5% year on year. So how do you make up for that, right? So one has to look at how quickly we can downsell the assets so that the profile of the income does not affect the return profile of the investors. And second, if our predominant borrowing is in dollar terms, now there is a masala bond construct where foreign investors are taking exposure to rupees, but that market is still very shallow. So one has to look at deepening the masala bond or equivalent market. And one has to look at, on a project finance basis, how do I reduce the hedging cost? So we're developing a sovereign level FX product where, give you an example, we've discussed with some of the uh, largest foreign exchange trading banks in the world. And they've come up with a very interesting concept of where is liquidity and where is that liquidity which is cheap in the world, right? So no longer in UK, US, because interest rates have gone up, right? They will come down for sure, but over the next 2 or 3 years. So if we look east of India, go to Japan, yes, Japan has moved away from negative interest rate territory, but still the interest rates are negligible. But Japanese institutions will not want to take the FX risk. So is the INR JPY hedging market deep enough? The answer is no. But if we create an INR JPY and a JPY USD pairing, we can actually reduce, rather than doing an INR USD directly, we can actually reduce the cost of hedging by 50%. So, so one has to look at sophisticated FX structures and instruments on how do you reduce the cost of money. So that's looking at sort of the second aspect, which is bringing wholesale finance into the system. And then comes the most critical aspect, that how do you actually reduce the cost of money and bring long-term concessional finance in the country. So we did some analysis that if landed at the project level, money was available through the developers at 7% or 6.75 to 7% in rupee terms, and cost of round-the-clock power was 3 rupees, 3 rupees 50. Right? The differential between green and gray hydrogen is almost 50 to 60 rupees. That's it. Right? So cost of money has a huge impact on eventual price of hydrogen. And then they look at a number of other structures where you keep on slicing and shaving the cost of money, and is eventually cost of green hydrogen that gets produced. So you bring the cost of green and gray to within striking distance, right? And then the government's already announced a 50 rupee, a 30 rupee, a 20 rupee subsidy for the next few years, and hopefully that should bridge that gap. So we developed a very comprehensive library of financial structures and instruments, and so think of these as different colored marbles. And depending on the situation, you'll bring out a red marble and a green marble and a blue marble to create the financing profile of the project and the structure. And guarantees will play a significant role. So the role of development finance institution is significant in this area by being able to provide those guarantee structures. So what we call blended finance in the universe. So this particular slide that you're saying, that how do you actually make the blended finance work? Now, in many of the cases, you will see that the development finance is actually providing the lending and the project finance to the projects. But a lot of the equity investors who want a higher IRR, right, internal rate of return, and development finance institutions want a greater DRR, what I call development rate of return. These are diametrically opposite, right? So if you get these two institutions to cooperate, what is that formula? One wants greater return, the other wants a lower return, right? So how do you get them to cooperate? And the answer lies in really development finance playing a predominant role in taking the risk out of the system. So if their balance sheet goes more towards guarantee structures and guarantee instruments that reduces the risk for commercial investors, then for every dollar that DFI brings in, we can unlock $9 from commercial finance. So making blended finance work is very, very important, and there's limited know-how and knowledge within the country on how do you roll these guarantee structures and instruments out, because they require some sort of a sovereign guarantee. India does not give a sovereign guarantee. So how do you make it work on a quasi or a sub-sovereign level is where one has to put a lot of energies. Uh, the last 2 points is the cost and availability of the technologies. Right? There's a lot of tech out there that's being developed. Right? India started also developing a lot of the tech. We were more users of tech rather than creators of IP. And when I say IP, I don't mean software. I mean this is hardware engineering focused IP. But if I bring those technologies from around the world into India today, it's expensive, right? So how do you bridge that particular gap? So one is making India kind of a base for indigenizing the solutions and then taking it out to all the emerging markets. Because if it works in India, it'll work in every other emerging market. But from a financing standpoint, there are structures that we can utilize today, and one is a capacity leasing model. Right? So you all know a vehicle leasing formula and format. It's time tested. Aircraft leasing, vehicle leasing, office space leasing. It's all time tested structures. There's nothing new. But this can also be extended to new energy. So where the equipment is standardized. So for instance, we're discussing with a lot of the electrolyzer manufacturers, guys, you do not have 5 or 10 year operating data, period, right? No lender is going to give money unless you take standard warranties will not suffice, right? Lenders want to see 5 or 10 year operating data. So for the first 5 years, switch to a electrolyzer leasing model rather than selling the capital equipment. So my capex requirement on the project comes down, right? And again, I can pass that through to the price of hydrogen. Now, even if I lease the electrolyzer, the developer still wants a service level agreement, a performance agreement, which is a 90%, 95% uptime, or whatever the capacity factor is. So you create an insurance product on top, which is a liquidated damages insurance, right? So if you say you produce 100 tons of hydrogen and you only do 90, that 10 tons differential, you have to pay for it. But this insurance product has to sit on the balance sheet of the OEM. If it doesn't sit on the balance sheet of the OEM, it doesn't work. So electrolyzer manufacturer. So if you look at aircraft, all aircrafts are always leased, engines are always leased. So why can't we extend it to electrolyzer model? And same way you can do infrastructure as a service. This we did on a farming project where we looked at advanced greenhouses, which these are climate controlled greenhouses, build hundreds of acres of greenhouses, but it sits on a balance sheet of the banking institutions, and you roll out the greenhouse as a service model. So infrastructure leasing again is a time-tested product, right? That one has to bring to the market. So, and finally, sort of the most contentious point is the price of carbon. Who is actually paying for it? Yeah, we can, until the price of carbon is established, a global floor is established, we're not going to be able to square that hole. So establishing a global floor is absolutely essential. There are other experts in the room who can talk more about it than I can. So we'll wait for them to sort of come in. And then, this is the sort of closing point is one has to move towards what we call no regret investments, first of a kind projects. If we don't put first of a kind projects, we will not be able to establish the commercial benchmarks, the policy, the regulation, the law, the HR capacity, the skills, right, around that particular aspect. So one has to move away from making is the project bankable today, right? Or where's the precedence? Where's the benchmark? Well, there is none. So someone has to come and establish those first of a kind projects. So that's really what we are doing. And then last slide is what is CETFi's role in this? So our first of a kind, first significant project is the GH2 market maker. Right? So we've established that as a legal entity, and we're now looking at demand availability, supply availability, price discovery, and once we've got a profile going, we will capitalize this entity with a significant balance sheet, and then this entity starts performing the role of the market maker. Already about 20 first of a kind projects, whether it's blending hydrogen with CNG to produce hydrogen, whether it's using hydrogen for EV fast charging because the grid availability is not there, displacing diesel gen sets with hydrogen. So a lot of first of a kind projects are already being developed. We'll start publishing those on our website, which we launch shortly, which is CETFi.org. So that's all in the report. And as I said, this report is kind of an evolving format. And those who are not present here with us today will share the soft copy with you electronically early next week. But contributions from all of yourselves are welcome. So that's the sort of background why we are here in a nutshell. And now I'd like to open it up to our lead discussants one by one, and then we can have a dialogue around all the points or new points that might come up. So what I'll do is I'll kind of group the discussion in three sort of broad category. Is what are the systemic risks? And for that, I'd love to first invite sort of the developers in the room. Pankaj is here from Renew, Mr. Gupta is here from Acme, and Deepak is here from Avada. So the developers in the room is if you can paint the narrative on how you as respective organizations are looking at the new energy economy. Individually in our discussions, we talked a lot about why more support is needed, in what form should that support come, and what are some of your experiences in developing these projects and getting them financed. So please always have a risk or a finance angle to your contributions and answers. So with that, I'd like to open it up to the floor. So Pankaj, Deepak, and Sukant in that order. I think Sukant joins us virtually.
Well, I think first let's congratulate on an excellent paper. Very confident.
Thank you.
Thank you, Sandeep, for wonderful presentation and giving an opportunity to express the view on it. I think you rightly pointed out that one of the major risks today is in terms of making the project bankable. So the few elements which are very critical for the success of green hydrogen sector, which is demand creation. So essentially, when we talk about demand creation, government need to come out with mandatory purchase obligation of green hydrogen, and the other lever can be in terms of imposing carbon cess on other industries, so that it could be cross subsidized to some extent, and that fund can be channelized to promote green hydrogen. Apart from that, the other element, if you look at from the bankability perspective, as you rightly pointed, is one of the major issues today is long-term offtake contracts. So today, off-takers, they are not willing to pay the price because it is almost 2 to 3 times of the price of conventional gray hydrogen. So unless one government put up the mandatory consumption, and the second thing is off-taker need to come out with conventional structure of purchasing it. In typically gray hydrogen market, they are used to short-term contracts of 5 years, 10 years or so. However, if you look at green hydrogen, it is completely capex heavy because entire process plant, RE plant, this is completely capex oriented. It's like RE. And the third element is in terms of financing. So if you look at INR financing, yeah, it is very expensive. So as you were pointing out that we need to reduce the cost of hedging, wherein it is linked with Japanese and then Japanese to USD, and we can reduce the financing cost. So and it is one of the biggest lever to make it economical. So these are few aspects which essentially government will look into it. Our government is doing very well in terms of extending subsidies, like they have come out with production link incentive recently, and HMS auction, and various developers are getting those subsidies. But if you look at developed world, they are offering quite extensive subsidies. We look at USA, they are offering roughly $3 per kg of hydrogen subsidy, up to $3. If we look at Europe, they have also come out with a scheme wherein they're extending subsidy to the tune of up to €4.5 per kg of hydrogen. So looking from the Indian context, because we don't have such deep pockets, the only way, one of the way through which we can make it, is the demand creation is mandatory consumption and imposing carbon cess. Yeah, I will invite Deepak.
Thanks, Anvik and Stan. So I have few opening remarks, and yes, because I handle both the equity financing as well as the international business development. So I've been monitoring a lot of these developments happening across the world. Now, obviously, the biggest challenge, and I think many of this risk can easily get addressed once you have a market in place. So even way back, 15 years back, it's the same amount of risk there even when the renewable energy was taken off. And the question was long-term uptake. Now here is set with the same question. Now there are so many dimensions that it added beyond pricing, actually in long-term uptake, which I would like to throw some light. One is while India is educating green, 100% green globally, but that does not mean that the world also should buy the narrative of green. So there is very liberal carbon definitions that some of this end markets have adopted, of 4 kg of hydrogen in Korea or Japan, 3.4. So that's practically for them. There is absolutely no incentive to move to green. So yes, in their own commitment to net zero and decarbonization, they are making some changes from gray to other molecule, but absolutely green is not a priority because the liberal definition which each of these countries have adopted makes them very convenient to skip green in the initial set of international tenders. The second aspect is on carbon pricing. Now, beyond Europe ETS, which is a fairly matured and they've entered third phase in last almost 15 years, and you have a clear visibility, and several houses have independent research houses have forecasted almost 150 plus euro price for carbon beyond 27-28 time horizon. If you look at the carbon pricing, what Japan started last year, the pilot study, today the Japan carbon pricing is just around $22. Korea, it's not even $10, despite Korea ETS in market for almost 6-7 years, but there is absolutely no carbon pricing importance given in that market. So long as you do some kind of a washing and you can manage the system. So it's a very liberal carbon emission definition that some of these countries have adopted, which is actually causing a more pain for an offtake perspective and not just the pricing. And the third very important factor is also partly India also trying its best, but we still not made too much of headway under Article 6 of Paris Agreement. If you see, Japan has already signed with 29 countries. India, Japan, they've done more than 10 rounds of meeting, but we have still not reached to any conclusion. India, Korea, India, Switzerland, India, Singapore, Germany, all the discussions are still happening. From the government perspective, I think we should push quite hard to the government to at least get into some of the serious end user countries to take this market off, because that itself would address so many issues which you highlighted, in terms of the overall risk. That if the Article 6.2 gets signed between any of these countries, you don't have to look for any other market. Those markets are deep enough to take all your demand actually. From a financing perspective, yes, all the risks are very well taken. No doubt about that. Now, we have been fortunate enough to already onboard one of the largest private equity player in the world to buying this story of green ammonia. But yes, so long as the demand perspective gets addressed, I think investors are willing to buy and back the developers who has proven execution track.
Which is why I said there's always money for good projects, right? Where's the demand coming from? How do you stimulate that demand? So thank you for that. So one of the 2 points I'd like to just.
In fact, I would add just one more point is also on the some of the countries have started imposing non-tariff barriers. While on worldwide they're saying that we are open for free trade, but okay, if you are buying it, want us to buy your molecule, are you involving our technology in your production or not? Now, why should we favor that technology versus other? We will go for international competitive bidding. There is no. So this is a part. This is an additional condition they are imposing on green molecule. The same condition is certainly not there for blue molecule. Because which is essentially produced in some of these major markets where gas is abundantly available.
So you have to bring energy security, right? Which is a macro aspect to it. So Japan and Korea are taking an energy security view, and that's why they're very liberal on the definition of hydrogen, right? So do you want to be a utopian world, or do you want to move towards that, right? And which is why I say, what are the levers available to us? So you mentioned the price of carbon. Pankaj mentioned demand stimulation. So if you take price without price of carbon, if you impose those mandates, right? Meaningful mandates. I'm not saying 50,000 ton kind of per annum mandates, right? If you're saying 5 million tons is in demand, so can we do a 2 million ton or 1.1/3 of that as a meaningful mandate? So the fear government has is any government, not just Indian, is the inflation that it induces, right, on the end product, right? So how do we balance that out? So if you look at ammonia, can we balance that out by reducing the cost of imports, right? So that subsidy, the $20 billion subsidy that Indian government gives towards fertilizer, can we take some of that money out and allocate towards the mandate? So this is why I'm saying one has to also look at a wholesale finance level, right? Not just a project finance. So thank you for those two interventions. And I won't comment on the price of carbon because we have a full dialogue on price of carbon. Is Sukant available with us online?
Yes, hi. Good morning, everybody. You'll have to just excuse me on my bad throat today, running under the weather. So I'd gone through the very valid points which you highlighted on the risk, the perception on the financing, etc. So we had been fortunate enough at ACME that, we have the first bilateral binding agreement executed for an offtake side, which gave us a lot of impetus on the financing side of it. So, while what you highlighted, the need of the day, we have seen the other side of that, how the markets do react once they see that kind of, the binding arrangement coming in place. But the challenge in financing, I would put in the following 2-3 parameters. One is that this is always a chicken and egg story, as you rightly pointed out, between who comes first, whether the offtake or the bankability. The financiers always keep looking for those long-term offtake contracts. Whenever we are doing new discussions with any of these off-takers, they look forward for where would be the status of the project would be, how realistic that project is, how much skin in the game has already been put in, and what kind of pricing, what kind of financing arrangements would be in place. So it's a very difficult tight edge which people have to walk on, trying to convince both sides of it to marry each other at an appropriate time. You will also see that once it also depends on the configuration of a project, which is one other different aspect. Because accordingly, what will happen is for a particular output of ammonia or hydrogen from a same kind of a capacity, the installation of electrolyzers, installation of the solar capacity, etc., can take the capex to a different level, which increases the problem of getting more debt financing, more equity financing to be in place for the same set of output on the tonnage side of it. However, what happens is as a result of it, then you need a larger consortium of financiers. But if you see today, the most of the appetite, if exists in a true sense is more from the DFIs, the financial institutions. The commercial banks still continue to remain on those mini palm and the medium term kind of loan financings, and getting both these perspectives, the long term financing as well as the medium term financing on the same boat becomes another challenge. And just banking on getting the DFIs, the FIIs, etc., to bring in the large pool of capital takes you a lot of time. So that's another challenge. And the third angle to the commercial banks is not only on the the tenor which they can offer. It is also that certain commercial banks, especially on the international side of it, have a lot of policy matters with respect to co-firing of, for example, green ammonia, green hydrogen with LNG and coal. Now, while there can be different sets of debates, there can be a different chapter on it to discuss about what is right and what is not, but that itself again curtails down the pool of capital available on that side from the commercial bank's perspective. So before this baby would have actually been born, there are already constraints on the policy matters which needs to be addressed. Whether we call it as a decarbonization, the people, they themselves have started putting in what do you say, constraints on defining the true definition. So that's another aspect we need to be wary of. And combined effect of all this is effectively then you have a funneling effect on the pool of capital available. And when I don't know when this funnel will get inverted and you will have a large excess like what happened in the solar capacities and the wind capacities will zoom out. But this is where the real situation today on the ground exists.
Thanks, Sukant. So you mentioned, and others have also, that in the case of the liberal definition of what is green, so standards play also a very, very important role in financing. So many of the European institutions, and Rolf can perhaps comment on that in a minute, will say, well, if you're producing green hydrogen or green ammonia for export purposes in India, then your policy or production parameters have to match those of ours, right? And that sometimes is at loggerheads with the policy definition in market here. And I'll give you an example. Biomass is one such area, right? So we put in India biomass sort of in a green category. EU does not, right? So then comes the issue of energy security, right? So why are we doing it? Because there's a lot of biomass available in country over here. So why don't we utilize on that energy form? So I think the standards that you mentioned have an impact on the bankability, because the banks would have a very, very different view of how they see the projects. And take your point on that it takes a lot of time for DFIs to kind of do the due diligence on the project, and which is why I say the capacity to bring blended finance to educate all stakeholders, that knowledge capacity pool has to be expanded, and number of people in that pool have to be increased. Otherwise, blended finance will just remain a nice buzzword, but our absorption capacity of blended finance will not increase. So thank you, Sukant. I will come back to all of you in a minute, and I'd now also like to welcome Mr. Jitendra from L&T. Mr. Jitendra, if you would have any comments on what your fellow peers have said.
Thank you. It's a very good and very knowledgeable session. Really appreciate the effort you have taken on the presentation. It has collated all the factors and facets of the challenges what we are facing these sectors. So my take will be, first thing is the term of the offtake. That is the first to make a project. What is good or bad? It has 3-4 dimensions. What is the term of offtake? What is the contract between offtaker and the developer? And again, you have to come out with a good concept, the IRR and DRR, the internal rate of return and the development rate of return, and where they crisscross each other and what is the expense. Another thing is the way developers see that no regret project, what you have mentioned. Do bankers also look at that, since it's a new sector, new thing is it? Do really they do in the risk? No. And fourth dimension is the risk sharing. The most important fact is the risk sharing between developer and these bankers. Who is taking what? Because nowadays, the off-taker appetite is very short term, maximum 10 years. Whereas wherever we work, it's 25 years, whether it's LNG or in a development project or it's a power project, we generally go for 25 years. So we have to look into that because these are adding to the cost because risk is increasing. So these are adding to the interest rate and cost of financing is increasing. So how to make a balance between these two, and we have to come out with a plan and process or system where risk sharing is a little bit equitable so that it will be a win-win situation for both. But that is the really the need of the hour because it's a very new sector. We need collaborative from each angle so that we can move ahead. Because the parity between gray and green will be there. Because the concept, the outcome, the expectation is completely different between two factors. We cannot compare apple to apple in this gray and this, although I am measured on this, but these are the different concepts. And as far as you have mentioned in your presentation, the RTC is 3 and 6.27, there will be hardly 60 rupees, which is $0.8 difference. RTC in India, 3 rupees, I don't know. It's a only theoretical, we can say. If you go to the market, it will be you know what is 1.5x or 2x, whatever you want to mention. Now, when you say true RTC, what I'm talking about, whether it's battery or pump storage. So these dimensions are to look into because red hydrogen to make it more competitive. Yes, I agree with my earlier colleagues that demand side we need really a good thing. Standards is another thing because even if Europe you don't know the standards, they are also yet to be come out with the real standard. Definitions, you know, thing right to and other things are yet to be finalized and crystallized so that it will give a comfort to the developers. So those things will we need to look into it. It's a time to say how it will go.
Great. No, thank you, Mr. Jitendra. You bring out an interesting, which is risk sharing. So can we share pass the risk down across the value chain that everyone takes a little bit of pain so that collectively the gain is much greater. So on a lighter note, if there are any bankers in the room, so I'll buy you a drink, but I'm going to do a below the belt hitting. Even if there is no risk, a banker will create risks, right? Because they have to make money. So that's on a lighter note. This requires a new asset class, right? So the first of a kind is a new asset class, which requires new, I wouldn't say new category of investors, but investors taking a different view, right? So one example given was, can we create RTC as a national priority mission mode project in its isolation, which is priced differently, risk is different, it comes with full guarantees of the government, and for the next 10 years, let's create that RTC capacity, right? Because otherwise, if we start pricing everything as if it was a steady state, we will never be able to transition across. So the transition economics is different from steady state economics, right? I'll give you another example. So EV charging is a classic example. I'll put 1,000 stations, but who's giving me the guarantee that the vehicles will come? But if you to get out of that chicken and egg situation, you partner with the vehicle and fleet owners and say, show us, and AI will play a very crucial role. Show us your routes, and we will make sure that there's enough charging capacity on those routes, right? So for the first 3 years, I'm going to make a loss on my network, but hopefully from year 4 or 5 onwards, I'll start making more and more money. But bankers will see making money from day one, right? Okay, I'll give you a 10-year loan or a 15-year loan, but you've got to make money from day one. If you leave the project to its own devices, which is hope and prayer that some of my charging capacity will be utilized, we're not going to be able to get off that particular. So every sector you have this demand-supply dilemma, right? At the beginning. This requires a new asset class of investors coming in, right? Where, okay, the returns are not high because risk is high, but if risk is high, that's where governments will come. That's where the development finance institutions come in to sort of give that overall padding. So all of you have mentioned market making as an important function, and I welcome all of you to partner with us on getting this market maker off the ground. So we can have those dialogues offline and separately. So thank you to all the developers in the room. Can I just sort of move on to a more concessionary finance and how the market making actually happens, and then we'll talk about carbon pricing. So to To talk about market making and concessionary finance, I'd like to welcome Rolf, who joins us very early in the morning from Germany. Rolf, welcome. Bright and early for you. I don't know if it's bright in Germany or not, but definitely early.
Good morning. Yes, thank you for the invite. Yes, it's not only early, it's bloody cold in Germany. So excuse if I'm not wearing a suit today, but just a jumper because it's really cold. Okay. Thank you again for the invite. So being very honored to speak at this illustrious table. Concessional finance. So we've heard a lot of discussion really about how to bring the money in, about all the risks. I would just like to present a couple of slides, not long, just to give you some examples of what is being done globally. And I hope this works now if I share my screen. I think that's the one. So I can't see you, so I just see my own screen. We've already heard it this morning. The hydrogen market is capital intensive, and I stole this slide from the World Bank just to give us a sense of the dimensions. And so we very liberally talk about, how many gigawatt of electrolyzers, and we know the government has its goal of producing 5 million green tons of green hydrogen by 2030. So I put up this slide for the purpose just to translate what it means for India. So if 1 million tons needs 10 electrolyzers, 20 gigawatts renewables, 30 billion, that means 5 million tons actually requires $150 billion of an investment to make it work. And so it's just simply a lot of money, and something to keep in mind. While we talk about finance, we do need to find ways to make it work. There are 3 ways, I'll show you now. The World Bank has its own project in India for 1.5 billion. This is, first of all, the German model. The German model developed by GH2 Global is also being copied by the European Bank. So the new bank is actually a misnomer. It is more of an interesting double auction system as a market maker, and this is really the relevance of global. It's a market maker. What it is essentially amounts to, it's a double auction system whereby Hinco does an auction for the production of green hydrogen. It offers 10-year hydrogen agreements, and then at the same time conducts auctions to purchase or to sell the hydrogen further on a 1-year basis. And so with this, and the difference, obviously, the purchase price for hydrogen is higher than it will be able to sell the hydrogen. We all know that the differential between green and gray is too big. But to bring that down, to give an incentive really for investment, Hinco therefore compensates for the difference. And therefore it acts as market maker, links actually, it works on, you see on the left-hand side, with the producers, with the developers, and they can be consortium. They don't have to offer the full amount, it can be split up. I think at the moment Hinco has 3 auctions ongoing, each for 100 megawatts of green hydrogen, green ammonia, and green methanol. And the consorts can offer smaller volumes, bigger volumes, usually more smaller volumes. And then it will then resell again. It has a second auction then for the industry, either refineries, fertilizers, for transport or energy, to resell it. Currently, I think Hinco has 900 million, which is offering, and it's really offering to doing it in lots of 300 million each, which probably boils down to like a 100 megawatt process. But in this regard, therefore, it's sure that it can always, because it always funds the entire production from its funds. Any funds it receives, proceeds received from the sales are just additional benefit. European Bank has gone up to, I think, the $4 billion. And so you can look at this. This is like a nice visualization of how it works. The assumption is, of course, that the price for hydrogen will come up over the next years. And therefore, the cost differential will be much higher at the beginning, but over time, as more industry use and there will be more demand for green hydrogen, the cost differential will come down. This cost differential, or the difference reduction, is also induced also by regulation. So most of you will be aware of REDCO, of RED 2, RED 3. There's also backed up then also by such also global regulations as the International Maritime Organization, which is trying to ensure that shipping goes goes net zero by 2050. And that's really the assumption that it is really somebody needs to get the market moving. Without it, we will have all the arguments as we have already heard this morning. Too much risk, no offtake, blah, 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 and so on. So the trick is really to get the market moving. And so this is one way really to provide incentive. I was grateful to hear that ACME has an offtake agreement. I know that Yara, they have the offtake with Yara. That's a very unusual case. Yara is really pushing to go very green, very much ahead of the pack. You have a second case of the H2 steel in Sweden. But these are more the exceptions. And this is just like, but they're nice exceptions. It goes to show that some companies are getting the offtake agreements. This is another way where H2 Global, therefore, through its intermediary HIMCO, actually ensures that producers can at least get 10 years. 10 years sounds, I know that infrastructure, we heard it's 25, but 10 years is still a long way to go and to help really things moving. So the double auction system as a market maker is like one approach. We were talking about concessional finance. I was asked to speak about concessional. I've now stolen two examples from the World Bank. The right-hand side, the Brazil, this is something which we're also with GZ is also promoting also in India. To get things work, obviously in hydrogen, it's very complex. You have an entire value chain, but nobody wants to pay more than for the initial investment. So the big question always is, who is going to cover the infrastructure cost? And obviously it has to go to government. So you have to create a public-private partnership to create a hydrogen value chain. Pecém in Brazil is probably one of the most advanced hydrogen hubs that I know globally. Brazil has the advantage of excellent solar, excellent wind, but also excellent hydropower, and is basically able to offset the whatever there's missing on wind or in solar through hydropower. Therefore, can pretty much guarantee around-the-clock renewable energy, which is brilliant then for the developers, and especially because you don't have to worry about running up your electrolyzers up and down. And therefore, it's so much of interest, and whereby the World Bank will, with concessional finance, then the innovation center and the infrastructure, so that the projects themselves have the shared infrastructure used and just have to focus on the private investors. This is similar to India, where we're talking about the hubs. I think the government in India has looked at 3 hubs. We're looking at more, but I think it's in Gujarat, somewhere on the off coast, and very much on the southern tip of India. So that's one approach, a public-private partnership. To go the next direction, but this is something the government can copy. And so invariably, let's say the funds for your concessional will have to come from, as there was a nice slide from Summit, usually have to come from government or from a philanthropy or from a multinational development bank, which usually then also goes back to other grant funds. The left-hand side is, let's say, takes the step of development finance and risk sharing a step further. Therefore, I'm showing it because it's really interesting. Because we faced, and someone had a huge list of risks to be mitigated. In this case, they're choosing actually to create a risk mitigation, a reserve account on the left-hand side to cover 2 issues. One is really to create a liquidity reserve account, and that can be for any reason. It can be that the technology doesn't work, or some transport issues go out, and the debt service account is there in case that the electrolyzer doesn't work that much and the company doesn't have the cash flow really to keep on paying it. There's like a reserve to cover like the inevitable, unexpected problems that you face when you're starting new markets and new technologies. This funding therefore is concessional, comes from bank, is also used the climate financing, the Global Environment Facility, the GEF. At the same time, the bank is therefore also offering financing to help finance the banks, the projects themselves. And this is where you can see by the bank providing its, let's say, seal of approval, of really having checked and believing in the viability. It's able, therefore, to leverage and to bring in also commercial banks and equity funds, therefore, to provide the capex needed really to get the green hydrogen banks up opening. And the key to this is therefore to having, and that's what you see on the left-hand side, the risk mitigation reserve account that gives comfort, therefore, to the more commercially oriented capital providers. Let me stop there. Didn't want to show a lot. I'm going to do a lot of slides, but it's more important to show that let me stop here. Let's go back.
Rolf, I have just a sort of question.
Yeah.
How do you take concessionary finance mainstream, right? Doing one project, okay, establishes the benchmarks, but how do you scale it up?
Can I pull up my magic wand? It is. Look, this is the class. This has been the challenge I think we've been facing for 3 years. How do you go from 1 billion to 50 billion concessional finance? Inevitably, I think everybody can do individual projects. I think in the end it will have to come from governments, and I think each government will have to provide for its own country, is my view. It's everybody tries to look at somebody else to do it. I think in the end, so the bank can do some things. The bank is being asked to do more. The bank, in the end, is also a bank and has to provide at least a break even by the end of the financial year. And so even the bank depends, as you saw, on the GEF, on the Global Environment Facility, which in turn is funded by governments. So I think there will be a need. The government cannot, in my view, let's say, provide concessional finance for the entire market. Concessional finance will be there just to get the market moving, to get at least the market moving. I think that's the key point. And as the market moves, then other actors then start to gain confidence. And as more projects are built and the manufacturers gain more experience, and this comes back to the economies of scale argument, then the cost for hydrogen will come down and the cost for renewables will come down. So if we go back again to the basics of green hydrogen cost, then let us always remember that India is the key position, that 60 to 70% of the costs are simply for the renewable energy. And if you can bring down the cost of renewable energy, you will also bring down the costs of hydrogen and make your project more bankable. Sorry, a long-winded answer, but that is the tricky question.
Ajay Banga at World Bank is saying that he wants to at least quadruple the World Bank's balance sheet, right? And do more in this area. So do you think there is now a growing recognition that transition finance is required to be developed? And I call transition finance specifically to be, as you say, as the market moves, economies of scale will kick in, risks will come down, costs will come down, and commercial finance can take over. So creating a new asset class is the sort of need of the hour, which I call transition finance.
Look, so I have great respect for Ajay Banga, and I used to work at the bank. And so I think it's a very tall order he's asking for. I think in the end, concessional finance, let us always remember again, concessional finance is The markets price risk because they have let's say, responsibility to their investors. And concessional finance comes from government saying that we need to move markets, and we have political agendas which the market cannot price. And so if he can get more people to provide things, if he can get more guarantees, if we can make the structures better, then I think we'll get the market moving. But it will
Yeah,
still
if the
depend on.
It depends. If the guarantees are there. Sorry, just interject. If the guarantees are there, then the money is there.
The money is there. There's no question. It's really providing the guarantees, and that's why I showed this model of how in Chile, providing an interesting example of providing this this liquidity reserve fund, which really will give comfort to the investors, and they will be able to leverage, I think, at least 1 to 5, if not 1 to 9. So we can do more of that. I thought that was a cool model because then it allows them gives the investors the comfort to say, look, some things will always happen, but we have this reserve which may or not be used. That's the nice thing. As a guarantee, it's still off balance sheet, but we're willing to provide it, and you can leverage. You can leverage more of the private capital, and B, you can leverage your own capital more because you don't have to put the money up front. And that's an interesting form of guarantee, which allows you, therefore, to provide more concessional financing, but without having to put the capital, because it's a guarantee, and therefore, as such, also off balance sheet.
See, I told you had the magic wand.
I'd like to there as well.
Please,
I mean,
please.
see, I think you talked about a very important point about ramping up concessional finance. Can you hear me?
Yes, I can. All good.
Okay, so you made an important point about ramping up concessional finance, and it's important. But I think if you look at the whole hydrogen ecosystem at the moment, there is a support required at various points in it. Simply looking at the cost of production of low carbon hydrogen, I'm going to say, not just green, but low carbon hydrogen, and looking at where you want it to be, there's a huge gap that you have to fill up. The question really is, where is the capital that you have available best suited to overall bring the two together over a period of time? And that's where so governments have to decide whether they want to give production linked subsidy, whether they want to spend money in R&D, whether they want to spend money giving incentives to demand side, and therefore the capital is still very limited, or they want to make risk products and guarantee risks. And that's the challenge in my view. You can't have concessional finance for a long time. Ultimately, it has to give way to commercial finance. So the best utilization of every dollar is how you're able to bridge this gap in a fundamental manner where the cost of production at some point has to reach the affordability level. Is it the carbon market prices have to go up to make it possible, or is it that the technology has to improve, this scale benefits have to kick in to be able to bring the two together? And I think that's a difficult question to answer for all governments around the world right now. Where do they deploy the capital to see this happen? You see governments deploying, we've just done some analysis. We've looked at governments deploying money in R&D, but it's not much, compared to the production linked incentives. The incentives they're offering right now to producers, or at least they're saying they're offering, are big incentives, a lot of money behind it. There is money behind R&D, perhaps a little bit less. So that question perhaps need to be answered first. How do you bring the two together? Because ultimately, if you look at green hydrogen, and you know as well, there is a certain minimum kilowatt hours you need to make, to split water. And even if you go to zero, you can't go to zero, of course, except in times when you have, let's say, solar day, when you have that duck curve coming in, suddenly a lot of supplies coming in from the market. And when you go to the negative pricing, but those are very few points in time where you have low renewable energy costs. Otherwise, LCO of renewable is pretty much where it's going to be. There are developers here, then you ask them, they're not going to be able to reduce it much further. So if renewable energy is not going to come down, how do you reduce the cost of green hydrogen is really critical. So that's, I think, something fundamental. And in my view, the capital that is there must find ways to be able to bridge this gap. And ultimately, only then commercial capital will come in.
I have one point to make out here. Gurpreet, that's a very nice point you raised. Rolf, hi, Chardonnay. So this is where to put that $1 first. Okay. And probably that first $1 could be fitted well. Let's say if you look at the hydrogen consumption stack, at the bottom of the pyramid, where the price of the hydrogen is also, they have the limited bargaining power. And the price of the hydrogen consumed by them, such as, let's say, I would say, traditional sectors, but let's say glass, sometimes steel, okay, steel, when I say steel, stainless steel, okay, even semiconductor. For them, the price of the hydrogen is still 400 plus, 500 plus. For them to transgress to a solution which is in the range of 400, 450 would make a sense. And if that 50 rupees, $1 can fit in there for such consumers, I think we would start seeing positive changes more on the ground. And always small is beautiful to start with, and then probably we'll reach to $1 or $3 gap going forward. And that could be one practical way to kickstart.
Rolf, you want to add to that?
Yeah. I mean, there's two separate comments. On the first one, I agree. This is like a real conundrum. Where do you start to put your money in to develop it? And so this ties to the second one. Do you provide a 50 rupee subsidy to make the market work? Or do you go into R&D? Do you go into production? So I'm honestly, again, here, I would like to pull up my magic wand again. And if you really, I don't think everybody's trying. I don't have the answer either. And I personally would believe a lot more in R&D. But the other hand, if you don't really produce it, you don't sell, then what's the benefit of the R&D for? It's still a chicken and egg. I still believe we have a lot way to go on the R&D. Most people, just the example of electrolyzers, most people think, oh no, let's buy the alkaline electrolyzers from China because they're cheapest. And yet we're seeing also stories that the biggest current electrolyzer of 260 megawatts in China is having massive difficulties because they cannot deal with the fluctuations in power. Then people say, well, PEM is better, but PEM is too expensive. You have one company touting now, I think, first mission in USA, they're going for SOEC, for solid oxide electrolyzers, because they can take high temperatures and take a real beating. Other companies are coming up with the next thing, which is anion exchange membrane electrolyzers. So simply in the field of electrolyzers, you have this Australian university model coming up with capillary electrolyzers, which goes your direction. Most people know you need like 54 kilowatts, 54 watts, what is it, per kilowatts per kilogram hydrogen. The theoretical minimum is 33. Practical, you're down to this Australian company can do it for like 40, 41 kilowatts. And that's because they get much more efficiency. Instead of the 70, 75, they can bring up to 95. So these are the things, for me, technology breakthroughs that really will bring down the price and the cost of hydrogen. Again, but it's not just the electrolyzer, it's really the RE. So if we can, through batteries and better storage systems, because we need the RTC, if we can bring the price down from, I think currently India, we're at 4.6. I read one auction. Solar is cheaper, but we need really the RTC to make the electrolyzer work. Sorry, going a long way. So I still believe in technology breakthroughs, but you still need the markets, the demand. You need the regulations and the policies to drive the development for people to see there is a future market. Otherwise, the R&D will just stay stuck with the academics at university. On the 50 rupees, yes, I think this good personal preferences really. So where do you believe the money makes sense? It could be help. The challenge with these subsidies is if you provide it on a production basis, it's very hard to, how long will you provide them? It's very hard to estimate the money that you need to spend. And that's the challenge with these kinds of open-end schemes, where it's really a question more of your government willingness to provide an open-ended funding. That's the challenge with those approaches. Samit, I have that answer. I have another question on the screen. Do you want me to answer that one, or do you want to take other questions first?
Let's complete the session and then we'll open it up to Q&A.
Okay.
If that's okay. Thank you. So we've sort of touched upon concessionary finance, blended finance, there isn't a magic wand, but as I showed in my library of instruments, there's a bag of marbles, right? So bring out the necessary marbles to tailor make the financing construct or capital structure for that first of a kind project. But the answer really is this is a new asset class that has to be created, different risk profile, and largely backstopped by the government. Backstopped, as I say, government does not have to take money out of its pocket because guarantees go a very, very long way. So that's something we will be developing and building in times to come. The final and the one that I am most excited, always animated about is the discussion around price of carbon, which is ultimately why are we doing this, right? We're doing this because we want to move towards a greener future, right? So the fossil fuel industry gets trillions of dollars of subsidy every year, right? So how do we transition away from fossil fuels? So someone's got to pay for it, right? And who takes that to take that pain, or is the pain shared by everyone in university? So to have a discussion around this topic, Anjan Das Gupta, our host from BSK, and Vishwajit from NVEX, who's developing a carbon exchange. So perhaps Vishwajit first. He's online. Vishwajit, price of carbon is the question, right? But a bit about what you're doing through your project and why it is very, very important and pathbreaking for India.
Yeah, good morning, everyone. Thank you for inviting me. I'm also in Europe at the moment, and it's freezing cold. So pardon my appearance and whatever. It's quite early in the morning. So a little bit about what it is that we do. We are in the process of getting a license for a regulated exchange in India. We already have several exchanges operating under the name of ACX, which was earlier called the Air Carbon Exchange, primarily designed for CORSIA or airline industry carbon credits. But now we've broadened the scope. We're called ACX, and we operate at the moment in 12 countries. We are headquartered in Abu Dhabi, in Abu Dhabi Global Markets, an independent jurisdiction where we have our first fully regulated exchange and clearinghouse for environmental assets, including carbon credits, renewable energy certificates, plastic credits. And we've also launched a biofuels platform, which is a matching service for biofuels traders. We don't do the physical, but we do the matching service. In India, we have initiated the process and filed our application with IFSC in GIFT City. The idea being that at the present time, we find that most of the trade around this asset class is cross-border and primarily having Indian sellers and foreign buyers. So to answer or to shed some light on the price of carbon, in fact, I'm at the moment in Florence. We just finished our conference yesterday. It was the International Emission Trading Association European Conference, which happens once a year in Europe. And there were three very interesting subjects that were debated. One was, of course, what we're all struggling with in India and in a lot of other developing countries is the Carbon Border Adjustment Mechanism, or CBAM, which, as you probably are aware, the Indian government is pushing back on. But it's implemented, it's out there, and it's real, and it's taking its toll on the cost of goods that are being sold into the EU. The second is the other legislation around CORSIA, which is for the aviation industry, which mandates that all flights will have to be carbon neutral, and the first phase of CORSIA has begun this year. And the third is legislation around maritime and shipping, where all freight will need to also be carbon neutral in phases, and the first phase will start in 2 years' time. So while we discuss how to go about doing it, the fact of the matter remains that, as was pointed out, the oil and gas industry is enjoying a subsidy of $7 trillion last year. So that is from start to finish, from across the entire chain. There are billions of dollars sitting there waiting to find their way into a credible opportunity to invest into decarbonizing, or at least low carbonizing the global economy. And we believe that the process to do that is to have more integrated, connected, and homogeneous carbon markets around the world. This is not a problem of any one nation, and the EU has taken the lead, but I think it's a problem that needs to be sorted out, addressed at a global level. And in order for that to happen, we believe that there is a necessity to have a global market where various stakeholders are able to interact and transact across the platform, so that a true price of assigned to carbon and decarbonization is found and discovered. Of course, it's also a function of the kind of projects that we end up doing. So there is a debate around offsets. There's a debate around what we call removals, where some of the advocates of the removal process believe that only removal will create true decarbonization. So unfortunately, I don't have a presentation because I've been just extremely caught up with this conference for the last 2 days. But I'm happy to take any questions, any interaction that you'd like.
Thanks, Vishwajit. Let Anjan give his views on the price of carbon, and then we'll take questions and views from both the floor and the audience online. Anjan.
Thank you everyone for coming here, and it's a great privilege to have all of you here. It's exciting times. I mean, we are really happy that Nish and Sanmit together decided to jointly host this event here. We've long, as a firm, wanted to and keep putting in the effort in developing new areas, and this is one of the areas that I think.
Sorry, you're just at the edge of the screen. If you can
Yeah. Okay. So this is something which the firm really strongly believes in, and we are focusing in this. Like Sanmit mentioned, some of the things to look at is CFD, leasing, carbon finance. Obviously, there's no magic wand, and it has to be kind of a blended approach in terms of getting the right mix. It's today in the press. I'm happy to we are working with Renew on a very interesting project with JERA. It's just come in the press today for green hydrogen project in Paradeep, and again, looking at some of these aspects like CFD to see how things can be worked out. But coming back to carbon, yes, carbon, we've all seen carbon financing in terms of the voluntary market and the mandatory market. We have and pricing of carbon obviously is the main issue, and that's where I think a lot of push is also coming from the government of India to kind of see how best that can be addressed. We have, as part of this process, we have been working along with the government of India to kind of work on some of these carbon related to maybe work on first setting the Indian carbon market and trying to work around that to then get the pricing right of all of this, and we think that look, the base has to be first set in terms of the regulations, in terms of all the players in the market who need to come in, to then help in kind of take this market and help in kind of achieve the objective in the larger macro scheme of things. And one of the areas, obviously, where the government is working is on the carbon credit trading scheme. And the government has come up in 2023 with the scheme. Still early days. They're looking at the National Steering Committee. They're looking at who will basically have oversight of the Indian carbon market. You have the Bureau of Energy Efficiency, that's BEE, which will be the administrator, and a lot of the recommendations of the National Steering Committee will then be kind of implemented through the BEE. The BEE is actually working in terms of trying to get this piece right, and we are expecting to see some kind of movement in this area shortly in terms of getting all the regulations and getting the nuances around all of this correct. We'll have CERC as the regulator and the grid controller of India Limited as the registry. Now, like I said, it's early days. The government is looking at trying to push and see this ecosystem kind of is put in place so the pricing and all the other bits in terms of the market comes into play and helps in kind of getting that price right in terms of how do we that's the $1 million question. How do we price it? And the intention, I think, is to move to the
7 trillion as per.
exactly move to the kind of trading platforms and see if a price can be derived out of that. But still early days, no magic wand. But the government is pushing.
But Anjan, don't you think, and both Vishwajit and Anjan, if you look at the current state of carbon market, someone's buying, someone's selling, right? Till such time the Kyoto Protocol was active, yes, there was a lot more money flowing to the developers. Now developers frankly don't care because the amount of money they actually pocket is negligible. But who's making the money in the middle? People have started to game the system. We saw. I can't be a judge here, but at least I'm an observer. How the forest-based credits and land-based credits, were developed. A massive market got created globally. But we realized that the actual value those credits had was overinflated, right? And the market collapsed on its head. So if you allow the market to self-regulate, greed will take over, and people who actually should benefit don't benefit, and everyone else who's far more sophisticated will come in. So the question is to all of you, and Anjan particularly, is regulation falling behind or policy constructs falling behind understanding of how to manage, create, and organize the market?
And I'll let Vishwajit take it, but and Vishwajit keeps saying, and by the way, we work with Vishwajit also on the Gift City exchange that he's ACX. Along with him, they're trying to come up with. But I think two of the critical aspects which Vishwajit always mentions is basically greenwashing and looking at retiring. And these are and you're right. The regulations around this is taking time, and I think as an organization we have worked on these ARR projects and pricing of them, and you're right. There is a clear mismatch, but at the same time, my take on it is, like you just mentioned, there is someone still buying and selling. So, whilst it's not perfect, but it is still happening. But whether someone is gaming the market, You're right. There is a huge debate around that, and the price at which the developer is selling and the price at which it is being ultimately sold, and the market in between is something which really needs to be looked at. And I think because of all of this, it's extremely critical that the government of India, along with BE, at least from an Indian perspective, we kind of can work around those regulations to ensure that the ground rules are set. Whilst it will develop and it has to develop, but the rules are extremely important that needs to come out quickly.
And you need transparency, right?
Absolutely.
You need transparency and look through in the market. We're not letting people don't earn your fair share of value that you're providing and the service that you're providing, but not at the cost of climate, right? Ultimately, the climate has to benefit. The proponents who are pushing the projects have to benefit, not agents in the middle, right? So there has to be an inversion of value metrics, right? In my opinion, that can only come from transparency. Vishwajit, you have a point.
Yeah, I'm gonna add what Anjan just said. You see, this currently the market is being driven by the voluntary carbon markets because regulation isn't in place and isn't robust enough. And this is something that I keep discussing on every single roundtable conversation that we have with the government agencies putting up this market. And that is that we've seen two markets that were set up by the Indian government post Kyoto, which was the PAT scheme and the REC scheme, and I mean, I think they lacked, if I may say so, in two ways. Number one was that I think that the regulation was too loose in terms of penalties, and I think the other thing was that we needed a true market where it wasn't just people coming in there once in a while and trying to buy something. You need liquidity, you need market makers, and you need to have a robust enough market which people have confidence in, which has legs and will last a long time. So with that, I think today we are sitting on a cusp where regulation has started to come in. And as you all are well aware, when regulation is new, it's always a challenge as to, how that will play out over a period of time. But I think regulation is now starting to creep into the market, and I think the European Union has taken the lead on that. And India is also quite advanced in terms of setting up a market. So we are operating in Abu Dhabi, we are operating in Singapore, in Brazil, in Indonesia. In Indonesia also has a regulated market which we manage for the government. So I think that there are three steps in this. The first is the regulation, which needs to come in at a country level, but I believe needs to be integrated into a global regulated market. The second is the kind of credibility that you mentioned in terms of some people trying to make a fast buck with some not so credible credits, etc. I think today we have the technology to ensure that that doesn't happen. But it is important that once the regulation is written, that there is an issuance mechanism which is robust and again, very clear in terms of what credits are issued and who issues them. Today we have a bunch of issuers who are not regulated or responsible to any government agency, so to say. So that's where some of the credibility issues around the market keep coming in. And the third, of course, is the enforceability. So I think that is something where we keep discussing with all governments that unless you make enforceability truly hurt, somebody from violating it's going to become difficult to implement the regulation once it's written. The other thing that I'd like to add is that in terms of the price of carbon. So today we have a voluntary carbon market, and so the prices are kind of controlled or discovered by people who want to offset their credits, and it's more of a marketing function than a pure finance function. But once the regulation comes in and once we've got targets, then I think that will give us a better price of carbon. An extremely low price of carbon doesn't help because it doesn't channel money into investment for decarbonization. But a very high price doesn't help either, because then it becomes, people start lobbying with the governments that they should be kind to their companies and not to at the cost of the planet. So I think an optimum price of carbon is what we have achieved, what we've seen the EU achieve through their ETS, and I think it's a good model. I believe that in India we will get that similar kind of pricing once the market is up and running. And to address this, the issue on credibility. So so that I explain a little bit about what we've done as an exchange, is that all the credits that are traded on our exchanges worldwide are all issued by one of the credible agencies that is already on our platform. They're all traded completely in a secure environment with full transparency on a blockchain, so that you can track every single credit. It is retired through all the registries that are linked to our exchange digitally. So all of these risks in terms of double counting, or in terms of the credibility around the credits, they're also all rated by either B0 or Silvera, which are the top rating agencies for credits at the moment. So we've tried to take out the risk around this market and the credibility issues associated with this market as much as possible. So I hope that answers some of the points raised.
So at least, thank you, Vishwajit. At least you've articulated the direction of travel, if not what the ideal system would look like. And I think the direction of travel is more transparency, embedding trust. And that was, I think you missed the very first slide that I mentioned, is establishing trust, right? And confidence. And governments have to move in that direction. And I think my call and submission to the legal fraternity is I think let's have more of these dialogues from a legal perspective. That in fact I'll say that, so NLU, National Law University, has asked us to organize the next roundtable on the regulation around carbon, right? And we'll have that discussion from a legal aspect. But if you bring transparency and structure to the market, the markets will start to function, and it'll reduce and eliminate, or if not eliminate, at least reduce the gaming of the system, and benefits should be accrued to those who are delivering those benefits, and not those who are profiteering from it. So thank you on both.
I'm good. May I just add one small point further to that? You see, the way and since you mentioned Kyoto and the carbon regime that we operated in, you see, we believe that carbon is a means for raising large amounts of financing for the decarbonization, and we are in the process of launching a projects exchange where you will be able to forward purchase the credits. So all the risk around it is what we are trying to mitigate, so that large amounts of capital can flow towards financing projects which really need this kind of money. Today, it's very challenging for project developers, as you're well aware, which don't have a strong balance sheet, to go out there and raise money, particularly for carbon financing. And this is what we really want to create. So it's, I mean, we look at this as an asset class, which is not just something where you want to go carbon neutral. That's one aspect of the market, but we really believe that this is a platform for companies to use to be able to access the carbon markets to raise long-term financing for projects.
Yeah.
No, thank you. I have a question for Vishwajit. Can I?
Yeah.
Hi, Vishwajit. This is Shardul here from Disha Power. We develop a lot of decarbonizing projects, and I have one particular question on the biofuel exchange that you just said. If you can help us a bit more about that, how it's going to function, number one. And number two, related to that question, you also talked about liquidity of the any exchange. That becomes a very important angle. So to bring in the liquidity, can we sort of think of having a fungibility of actual mandates, blending mandates to purchasing of the carbon credits? That's my second question.
Yeah. So to answer your first question, I mean, we have a biofuels platform, which is a matching platform for the trades, mainly around biodiesel at the moment. And we've also launched a SAF platform where we are expecting legislation to make SAF mandatory up to a certain extent. And as you're well aware that it's not so easy to move SAF around. So we will be trading the certificates so that airlines will be able to purchase them as SAF eligible certificates. To answer your second point, yes, we are actually very much pushing for fungibility into the carbon markets. However, at the moment, I think the regulators are caught up with the fact that who will permit what and how much. That's, I think, where the whole debate rests. I mean, in fact, yesterday is very interesting because I was in a session where we were discussing the impact of CBAM, and there were lots of companies in the room, including large mining companies based in Brazil and other parts of the world, and they were very, very adamant that they should be permitted to use offsets. And today, as the regulation stands, the EU has permitted offsetting in ETSs which are operated in certain countries. So Singapore, for example, you can use the offsets for goods coming from Singapore to the EU. You can use Singapore ETS for offsetting on or the CBAM requirement. India is fighting that, but I think unless we have an ETS in India which is credible, acceptable, and run by the government, we will continue to see this struggle. And today, I think, if I'm not mistaken, I think the last value of it was $70 a ton plus for credits which were required to meet CBAM obligations. So it's an expensive regulation. I don't know if that answers your question, but
Thanks, Vishwajit. I think that we'll connect offline. Sure.
Yeah, absolutely. Anytime.
I have one question. What is the timeline we are expecting in India this to be really ground?
I think it will. I think
standard. They have formed these secretaries, and they have identified, and they have one abbreviated name. I'm just forgetting. They have put something. I'm just missing that. But what is the real regulation when they will come out with this?
See, the framework of the regulation is there. Now the rules have to come out.
Yes, and that is more detailed.
Exactly. And BE is working on that. And we actually expect that after the elections are over, they should be
what's expected is that typically what was the CAT scheme, perform, achieve, trade, on energy efficiency, some of the sectors like steel will transition away from PAT scheme, move into the carbon market scheme, and therefore the carbon prices will be set based on the carbon budgets. So all your carbon auditors, the energy auditors will be trained to become carbon auditors, carbon assessors, and for industries, they'll set benchmarks like they used to do for energy efficiency. They'll set benchmarks for how much carbon emissions you can have. And I think that's also a little bit of a challenge because carbon prices will really depend on demand.
Yes.
And if the targets are set too low, and that the credits are available to everyone, and there aren't enough buyers because you're not making that mandate or keeping that caps on how much you can emit, then how do you create the market? And first of all, if it's only within steel, then it's a very small market. If it's a multi-sectoral market and there are number of issuers, number of buyers, then the market starts to thrive. And beyond that, as you were saying, the Korean market is still at $8. The Chinese market ETS is still much below that, $4 or $5. European market is around 70 euros. But if you look at coming to the green hydrogen context, if you compare simply grey hydrogen, green hydrogen, grey hydrogen you make from natural gas. You assume even a $15 natural gas price, which is high price, and you look at current green hydrogen costs in India, the gap is a lot. It's about 150 rupees a kg that you still have to bridge. And I don't know, I think the calculations are correct. Someone tells me that you need a price of more than 300 euros per ton of CO2 to make the two equal. And please take these calculations with a pinch of salt. We have to verify. But it's almost 3 to 4 times the current Europe price, which is almost 70, 80 or 100. It's touched $100. So it's, to me, the carbon pricing, setting up the hydrogen is still far away, because you're looking at voluntary markets at $4. You're looking at Chinese, Korean, Asian markets very low. We don't know where Indian market will come. So that financing your price cap or cost cap between gray and green hydrogen is still some distance away.
Yes. And we've been telling the government, look, the PAT scheme, you can't have so many around. You need to roll everything in and make one robust market in terms of the Indian carbon markets. And I mean, one thing was you had the green credits also coming out, and that these are the things which also create a lot of issues within the market, because multiple regulations, multiple regulators, multiple ministries. So let's see where it comes to, but I think it will be, we are hoping to see something after the elections. Sure.
So
Can anyone, sorry,
Yeah,
I would like to add something to this entire group around the table, because I think we're all sort of trying to fight the same fight. I think the fact is that we all must look at carbon markets as a means for raising financing, not just to meet some publication of numbers that, oh, we have offset so much and we have this, our greenhouse gases have come down by 20% or 30%. If once we start looking at it as a market to really access large amounts of capital inflow into India, which I believe we can, then we will realize that the regulation needs to be written around that, not just around, I think, since you mentioned the PAT scheme, I think one of the challenges of the PAT scheme was the fact that you could only trade that particular asset once and you could only retire it. And hence it became a tool only for corporates to say, okay, I've done my bit and that's it. But the fact is that, once you look at it as a long-term financing opportunity, then everyone looks at it, every corporate looks at it extremely differently.
Could we add a derivative to the?
You have to, yes. I think eventually that's where the market will go.
Yeah. That's the only instrument that then allows free trading of the. So, I mean, it's happened already, but I can officially open it up to the floor, both people in the room as well as in the virtual room. So if anyone has a question, those who have joined us virtually, please either put your question in the chat box or you can come online and ask the question. And I'd also like to welcome Mr. Pradeshi, who's the head of Mitra, which is the government of Maharashtra's think tank. Welcome, sir. Thank you for taking the time again. We just had a good 2-hour discussion and debate on how to get green financing moving. So I think
the last half hour online.
Oh, did you? Okay. So then you can answer the question, right? What's the price of carbon, right? And who pays for it? But on a more official note, thank you. And really, the construct is around where do governments come in not just creating the legislative framework, but also getting the markets moving, right? Because if you leave the markets to their own devices, they'll automatically and naturally resort to their realm of comfort, and which is commercial finance, right? And what we need is transition finance.
Yeah.
So the governments will have to play a greater role in giving that confidence. And what we are saying is creating guarantee structures, guarantee instruments, backstop instruments is one mechanism. But the question that's still not answered is price of carbon. Who pays for pollution essentially, right? So we are saying as we keep on fighting in the World Forum on establishing a floor on price of carbon, which doesn't induce inflation, There are other measures, instruments that we can use to bridge the gap between gray and green. So why just wait for that? Let's get the ball moving. But perhaps you can give us a kind of an overarching view on where you're sitting at, what both the government of Maharashtra, and you come from Delhi, so you have a good sense of understanding and what's happening in Delhi as well. So a few words from you, and then we'll have a dialogue.
Thank you. Thanks for this initiative. So I think my first point is that green carbon, as somebody also was remarking, utilizing carbon through setting a carbon price is not going to happen in India for quite some time, because India doesn't use price mechanisms to as a policy instrument to eliminate environmental externalities. I think they are far away. We need to move on that. But just like if you travel in Europe, you pay 40% tax on your petrol, which is the carbon tax, which helps you to go towards public transport. We don't do it like that. We do it in another way, which is we have a blunt instrument, Maharashtra Pollution Control Board, which says, okay, you can only pollute up to so much. And it's a regulatory mechanism. It's not a market mechanism, which says that you can't pollute beyond this much, or cars have to fall into these standards, and we check the cars and penalize them. We don't price them, price them out of the market and price them into green. So that's like one big thing. How far the policy will move towards that, I don't know. It's like plastics. We try to ban plastics. We don't try to price plastics towards recycling by giving that incentive for recycling. So that's the first issue. Having said that, I think again, what the government is doing is again moving on positive incentives only. So basically, if you look at the Maharashtra's green hydrogen policy, I don't know if some of you have looked at it.
Yeah,
You've all looked at it. So I mean, it's such a huge fiscal burden. I don't know how it can be done. I mean, it talks about the first 3 anchor units to have 30% capital sustainability. That itself, you can imagine an anchor unit of the size that is envisaged. So that's one. Then secondly, 50% duty of all electricity charges write-off. Plus, it accepts fungibility because green hydrogen will not be produced through green sources at site. So it allows offsets. That is, you can pay for solar energy and then use that solar energy to show that you offset the green hydrogen which you are anyway producing from the regular grid, which is so. But the series of incentives are very heavy. So I was quite interested in finding out whether there is. I learned a term called FID, Final Investment Decision. The last 4 years, I was talking to lots of big companies like GH2, Energy, then also Reliance, and all of them said that we are studying the market, but we haven't reached FID. Because the market for this is still not there. Now, in terms of the market, the first concrete market that I know of is those who are producing steel and have to export steel to Europe. That's the first concrete market for hydrogen, because they have to use hydrogen, and otherwise, steel is going to be not importable. So that is a plant which is going to come up. JSW is moving hard on that, and they will convert to green hydrogen, and they will offset it by equivalent solar energy. So India has been able to reach the lowest rates for green solar. Now, after looking at all of these issues, there are one area of concern and 2 positives. One area of concern is the weaknesses of the state electricity boards. Because all of this hinges on the ability of the existing electricity boards to distribute energy and recover some cost so that the subsidy mechanism works. And all of them are highly stressed. So this is one issue. We have a solution in Maharashtra on which we are working on, and I'll just tell you about it. So that's like the state electricity board. But without correcting the state electricity boards, whatever we do for carbon financing it all collapses on the fact that each of the state electricity boards are leveraged on so much of credit. They are just running on and paying interest and on government buying guarantees. So, and everything has to go through them. There's very little which can go without going through the state list. So that's one issue. The second good thing is that I think we never were in time for most of the big changes. Like we didn't move in time to the manufacturing, we didn't move in time for the textiles. But the one which we got right is the solar one. Both because we have a lot of solar energy and our costs have come down substantially. We are among the cheapest solar producers and the largest per year incremental additional solar energy. So this is a very big plus for hydrogen and offsetting. Now, how this can be used to offset the negative balances of almost all state electricity boards, this is a very big opportunity. If you get this opportunity, then your financing issues all get reasonably sorted out. Like if you look at Maharashtra, which is really a well-performing state, you would be having an average backlog of, let's say, deficit of 40,000 crores roughly on the state electricity board, and annual build-up is 8,000 crores. So it's 16,000 crores is the minus, of which 8,000 government compensates, and the other 8,000 they try to get it from higher prices to industry, which makes industry unviable. Because their price of production might be 5 rupees, but they give to industry 8 to 9 to 12, 15, depending on the region, and industry becomes unviable. And so main reason is the farmers. That 30% of the energy right now, almost 40 goes to farmers for pulling water out. What Maharashtra is doing, and we are pushing it in Mitra in a big way. We have picked up a loan of $1.1 billion from Asian Infrastructure Bank and another $500 million from the World Bank, plus our own scheme to completely solarize agricultural irrigation. So in the next 4 to 5 years, we add 1 lakh irrigation pumps every year in Maharashtra. And nobody can say no to them because they pay or they don't pay. And secondly, there is existing lot of about 48 lakh pumps, which don't pay anything at nominal prices. They draw a lot of water. And nobody can say no to them. Anyway, it's not in economic interest also. If all of them can be put on solar in the next 5 to 10 years, then the entire electricity producer becomes focused only on commercial, which is cities, domestic, and industry. The average price comes down to 5 rupees. Its ability to pay for all green just climbs up, and this becomes a standalone solar system. So we are moving on that. That could help. Having said that, I think right now what we should focus on is looking at where there is good solar energy, connecting it to hydrogen for industrial clusters only. If it's for domestic, if it's for export, then of course port-linked hydrogen is the best. So if it is for industrial clusters, so you identify industrial clusters like Pune or in Thane, wherever there is chemical-oriented industry which can use hydrogen as a source of fuel, and you just have hydrogen manufacturing there with solar energy using government of Maharashtra's anchor investor subsidies. So this can start off the initial large production in hydrogen. But so one company I'm surely doing it. The 3 companies have signed up in Maharashtra. One I think will generally do it is GH2 because their steel does need it and they are very serious. They've already moved very fast on the back end of it, which is to mobilize that much amount of solar power, which is needed to offset the required for hydrogen. So their steel plant at Dolvi could become possibly the first fully green steel plant on this way. So just my last sentence on your offsetting carbon prices, the way we are doing it is through like this method. We are not just giving negative pricing for generating carbon. We are trying to give positive incentives through the fiscal burden of the state to pull people into the green sector, not to disincentivize the externality of carbon production. So that's one policy measure that I think we should promote. It's much cheaper.
Great, thank you. On the solar for farmers, it's absolutely a no-brainer. It has other benefits as well, maybe playing out much more in northern India.
Everywhere.
Northern India has a very peculiar problem. Northern India draws much more water because it's a water surplus region
Yes.
than Western and Southern. Here, the attitudes to water are still a little bit more serious, whereas Northern India.
Still, we also overdraw.
And when the crop burning season starts, it creates microclimates.
Yes.
Because there's more moisture on surface, there's more evaporation.
So there's more smog.
More smog because the
fog becomes smog with the smog,
smog, right? And it's a direct correlation with groundwater extraction and surface water.
Excess water.
Direct correlation.
There's so many things.
So
Salination of land, for example, which is now increasing at great pace in Punjab and Haryana.
Yeah.
All of that can be controlled by moderating the
water consumption. So how do you convert? So basically, this again comes back to an incentive mechanism, the green credits scheme. But who embeds the value in that green credit and who pays for it really is the.
So actually, just if I may just explore that a bit further, within the way the incentive structure is made, there are actually very many negative incentives that is which promote carbon in a positive way. Let's look at the urea subsidy. So it's such a big subsidy. So it's impossible to use, let's say, cow dung nitrogen. It's cheaper to use urea by many at times, which is very carbon, let's say, not neutral, including the transportation costs. So these sort of subsidies, unless we get rid of, forget about positive subsidies, even if we can correct these distortions embedded, we can bring about a lot. No municipal, I have been municipal commissioner Mumbai and Pune. No municipal commissioner can convert the organic waste into manure, which can sell at a viable price, which is even twice the price of urea.
You'll be very pleased.
Yeah.
So this is a project we've been working for the last 4 years. Mumbai, has issued 5 tenders for big sewage treatment plant.
Yeah.
So the sludge that's going to come out
That's very good. Yeah.
is also a problem. So
That's a very good source.
So we got 4 ministries together: Ministry of Jal Shakti, Ministry of Housing and Urban Affairs, Ministry of Agriculture, and Ministry of Fertilizer. Of course, Ministry of Finance have to play a key role. There's $20 billion of subsidy that goes to the fertilizer sector. So even if you move some of that towards this, but no single department was willing to take the inside cost. So the landed price at the farmer's doorstep for green soil enhancer, soil conditioner products.
You can even call it 1:1. There is 1 kilogram of nitrogen in that sludge versus 1 kilogram of nitrogen in urea.
Yeah. So the landed cost, we've done the math, is 5,000 rupees a ton. Farmer is willing to pay 1,000 rupees, no more than that.
And urea, the equivalent of that for urea would be much cheaper.
Much cheaper. Right. So now we've got a pilot program going where about 1,000 tons per day pilot is starting, where you blend sludge with organic waste from MSW and you create a homogeneous product.
Yes.
Right? So the fertilizer companies have agreed to brand.
And they have a regulatory requirement.
And they have
RCF has it.
Exactly. So RCF is a requirement on that.
RCF is doing it in our solid waste.
I know. But now they're willing to go nationwide.
This is better.
So 1,000 rupees a ton, 4 minutes each. 4 ministries are willing to
But the better, easier way to do this is still catching a year like this. It's just to catch it like this, which is to say that reduce the subsidy on urea almost completely. And in fact, if you want to subsidize this, that is the recycling of cow dung, agri waste and sludge and all municipal organic waste. So you will get the same amount of urea, but much better nitrogen, which is better for the soil compared to the chemical, and clean up the cities.
Exactly. So the way we are doing this is, sort of mission mode, which is topsoil rejuvenation.
Okay.
Right? So bring carbon and nitrogen back to the soil.
Yeah.
Right? How do you do that? For soils to be called organic, they have to have 15, 16, 17% carbon. Our soils in Punjab, Haryana are at 2 or 3% carbon.
Yeah. Everything.
And everywhere it's kind of going up. So incentivize production yield at the farm level, but we can actually bring money from a number of sources, right? So the answer, thank you for bringing it out. So the magic wand is find inefficiencies in the system to move money towards.
My
towards the
ideal
capital
solution, Mr. Piyush Goyal had spoken to me during the last election, when it came to the second election. Maharashtra had done the farm loan waiver, again under pressure of Shiv Sena too much. SAM was not willing to do it. I was advising against it. But anyway, they did. So Mr. Piyush Goyal had the charge of finance minister. He called me and said, "Okay, आपने कैसे कि हमको पूरा देश भर करना है." I said, "Please don't do it. You first, if you do the farm loan waiver, it goes to the bank. It doesn't go to the farm." So that clicked in his mind politically. Even if you today announce it, the money that you are going to write off is going to go to the bank. The farmer doesn't see a rupee of it. So what you do is you give a direct subsidy, because this is what Europe does and everybody does. So he agreed to the 6,000 rupees. Then Maharashtra added another 6,000. So we now give 12,000 rupees to every farmer, irrespective of what he does with that money. What we have to do now is to calculate the total amount of urea subsidy, which is maybe, I think, maybe 1 lakh crores. I don't know how much is it now. So, and say all of this will be wiped out, but it will be divided in 1.120 million farmers on a pro rata basis, and it will be given. So you will still get the money. You can decide what you want to do with it, but you will not get it as urea subsidy. So whether you buy urea or whether you buy cow dung and process it on your farm, it doesn't matter. You decide. It will completely correct the market.
So there is money in the system.
No, and
right?
politically, and it's politically the right thing to do, because farmers will get it directly.
And
Like
that
the LPG model.
Huh?
Like the LPG model. Yes, like the LPG model. Now, a lot of the things we are doing like that. Even for the student scholarships, we're moving to that. Giving it to the student rather than to the engineering college. Otherwise, they have a hidden agenda in getting people in and then claiming scholarships which run their whole course, but their education is of no use. People don't even attend their class. Private.
So direct benefit is what kind of or lack of direct benefit is what distorts the market. Right?
Absolutely.
And allows for gaming to happen. So
Yes.
a perverse incentive on farm loan waiver playing out at the farm level, the agent who's actually getting the farmer the loan or helping the farmer to make the application is charging 40%, 50% commission.
Yeah, but
Why?
now,
Because they're saying,
but now we did it through DBT. The farm
DBT
level, we did it through DBT, and
DBT
it took a lot of time.
Yeah.
We put it. But the issue is, see, a farm loan waiver is, the only advantage of farm loan waiver is that if a person is in default, nobody can attach his land. Indian laws are very strict. No bank can attach agricultural land even if he is in default. So that's a good. Premchand, our great story writer, did this for us a little bit. But then what happens is he becomes a permanent non-loaning. That is, the bank will never lend to him. So this is his only disadvantage. Why they keep saying humko ye maaf karo? Because next time round he should be able to take loan, which he can't once he is gone. So farm loan waiver only enables him to get the loan next time round. That's the only advantage. Now the fun thing about it is that we did a CAG audit check. Banks are so wise. They looked at all the farm loan waiver people and they said, "Ye to waise bhi dene nahi wale hain." So irrespective of the fact that they received their money, they never gave them loans again. Because they called them as bad, bad defaulters and habitual defaulters. So in that sense, also the farm loan waiver didn't really help those farmers who had been. So it's a total waste of money. It only helped the cooperative banks to get back huge amounts of money. So that was the logic we used to give directly money to the farmer, not in the form of a loan waiver.
and which is what the previous discussion was, that why the carbon markets are failing, because the beneficiary who's actually delivering the solution is not benefiting from.
So can you just highlight, because that is one more question and I'm a bit confused on that. And I heard somebody saying that since the Kyoto Protocol is no longer that active now, so the international carbon trading has gone down a lot.
So what's happened in India?
What is happening? Because there are some people who came to me and we have floated a tender, which is called identifying forests, which they will look after for 20 years and for which they will generate, I will not pay them anything, forest department, but they will generate carbon credits, which they will share with the government and all. So I have my doubts whether this can happen, but please enlighten me whether it can happen.
Maybe Vishwajit, do you want to take that?
Yeah, so there are methodologies for forestry carbon, which are well defined. There are many standards which are available. But they can register the project under where or anywhere they like. But just to give you a little bit of introduction, one of the big opportunities that we see on our exchange actually is that, these project types, particularly being floated by the government, or, where the government has a tender, they can list directly on our exchange and get full price discovery and transparency. So you don't need to do any
Intermediation.
RFQ or anything. Sorry?
No, you're right. But, government is, even to write an RFP will take like 6 months. We don't understand the things. We don't mind if an intermediary comes, and we don't mind that in the first generation they make money out of us, because we are not losing anything. In the second generation, we can learn and do it directly. But I was first concerned that I can share. What I'll do is I'll share our RFP document. I'll take his contact. So I will share our EOI and RFP document for Maharashtra's forest. We have tried to put out the entire area because a lot of people came and we will, help to maintain it and generate a grade, and government will get a share in it. So I will just share that and see if we.
But
So, we are from ESP Legal. We have. Sorry, Vishwajit.
What I will suggest is that, while you can fix your percentage sharing, you can ensure that the credits are sold on an exchange so that you get full price transparency.
So that part we have left to them, because we are not paying them anything.
No, but enforce that, because that's where gaming starts.
So what I do is I'll share the our RFP document. Anyway, it's not finalized. So if you can give us some.
So we worked on a similar project in similar project in Madhya Pradesh. We will have a discussion with you and we can take it.
Madhya Pradesh already did
we are doing a pilot still.
No, but has it been allotted?
There is. So it's starting now. The pilot was over. Now the main project is starting. I'll come and discuss this.
Please help us to write this RFP better. So
In Tamil Nadu, this was already awarded.
Awarded?
Yes.
So is it to a private entity?
Yes, the private entity.
And can I just take a minute to get into that?
Yes.
Yeah. So did they look at an existing reserve forest of the government?
No.
Or are they going to reforest a degraded land?
They're going to reforest a mangrove.
They're going to reforest a mangrove. Okay. It is not on an existing forest area which is to be maintained and.
No.
You can do both.
You can
do both. Yeah. So we had put the other one. No, not for BFR, but we can do both.
You can do both. And the credits for them are priced slightly different. Okay. One is immediate.
Additionality comes in here.
So that kind of answers one particular question, that markets have to be transparent to stop the gaming and leakage of the monies. And that's where exchanges play a very, very critical role in price discovery and price transparency. And the second aspect is that there is existing inefficiency in the system, financial inefficiency. And if you can somehow unlock money, starting with pilots, right? And that's where I call the no regret investments, right? And if you look at one of the first recommendation on that aspect is shadow regulations, right? Regulations will take time, 1, 2, 3, 4 years to come through, right? But you can't wait for a perfect universe. So create shadow regulations to sort of jumpstart the market through pilot and first of a kind demonstration project. So again, this is a new asset class that has to emerge, because traditional investors will see the IRR concept, whereas we want the DRR concept, right? So how do you price DRR, right? Intangible benefits are fine, but you've got to make those benefits tangible. Right? You've got to give a number to the actual financial investment.
And some of these things you're exactly right, because the regulations are not there. So what we are trying to do, empower the local communities itself to try and monitor these projects and see that you kind of get the benefits of exactly what the so-called carbon was for.
Yeah.
So that these are something which we're still working on.
And a submission to a number of Vishwajit, maybe to point relevant to you also, a number of people who are creating digital platforms for carbon financing. Our submission to them is, don't try and channel all the traffic through you. Make a sort of white label model, enable the infrastructure, but it should sit within a government or a quasi-government entity, right? Because otherwise you will be prone to private sector pressures, private investment pressures, and kind of greed will take over, right? If you provide the backbone infrastructure, the trading infrastructure, and take clipping from each trade that's happening rather than owning our data, the trade has to go through us. We will not give price transparency. Those models will not fly anymore. Right?
Yes, so I'd like to point one out. In Indonesia, our exchange is run. We have a JV with IDX, which is the Indonesian stock market, and it's a government-run and monitored exchange. So we provide the technical infrastructure, the global connectivity, the common order book, the liquidity pool, all of that. But it is run and managed by IDX and the government. So the credits are issued by the government. IDX runs it.
And that's exactly what the model that we are proposing to all startups.
Yeah, that's what. Yes.
So we're developing the first wastewater trading exchange in India on exactly the same construct. Right? That you enable each municipality and you white label and give them the platform, but and provide the backbone infrastructure rather than owning the trade. Right? So the trade can go through your infrastructure, but it technically sits within a government agency. So models are all there, and like I said, in the library of instruments, take out the relevant models. Right? For each solution, each problem, there's a different set of models, and that will create new form of climate finance, right? Because you need a blend of both public and private, right? We cannot just finance it from public. There's not enough money, and you cannot finance this from private because there's not enough return on capital deployed immediately. And that's where the new approaches to climate finance kind of kicks in. So any sort of final questions, comments? Sorry, you've been quiet and patient, please.
No, thank you, Steve. First of all, introducing myself, Managing Director and Founder Managing Director of Eden Infrastructure Advisory. I have got a few comments on the discussion. Very interesting discussion. Thanks a lot for organizing this. Thanks a lot for inviting. It has been very enlightening. The first comment is about the CTS, essentially carbon trading scheme that we are talking about. How much we are going to be really dependent on the raising carbon finance. In India, the CTS which is talked about and the BE, what it has prepared, the first set of companies where the mandatory CTS would be there is only one, is around 94 units, right? So, and which covers very, very fragmented portion of the industry to participate in the carbon trading scheme. So this is the first cycle which consists of only 94 units. If you look at the PAT scheme, which came into being in 2010, and in 2012-13 it got implemented, we still have got only 1,300 units, or less than 1,300, 1,290 or something units. So how much money would really be raised through the mandatory carbon market that would come into play in India is something I think which all of us need to be aware of, or cognizant of in this. Incidentally, RE certificate scheme as well as the PAT scheme design, I was personally involved. So RE certificate scheme, in fact, one of the things which, in fact, Vishwajit also talked about is single cycle. Okay, which is our once through feature, which actually killed both REC scheme as well as the PAT scheme, because it just didn't allow any other market makers to be in the market, which was not a part of the original design, which came into its for some other discussion on that. But even REC scheme, if you see, the study which that is a POSOCO now, or the earlier POSOCO or GRIDCO now, has brought into the market. So their estimate, which was the study which was done around 5 years back, suggested around 8,000 megawatt of capacity has come through because of the REC mechanism. Okay, so ability of these instruments to finance a new project or ensure the financial closure, I think is suspect. Even if you bring in CTS, so we have got REC, we have got PAT scheme, we have got CTS. The ability of these schemes to be able to generate finance and to be able to achieve financial closure is going to be limited, at least by whatever structures that we are talking about today, even in the CTS scheme design. Again, CTS scheme design, we initially started with a voluntary market design. Now we are talking about a mandatory market design. But at the end of the day, the basic fundamental of the scheme is same. And if you see the CTS is exact replica of PAT scheme, so it is going to be the intensity-based targets. And so the whole discussion about the normalization, which is there, which is a kind of a gain for the PAT scheme, would continue to be there in this particular scheme. So that was just a word of caution for the carbon finance-based financing that is possible through the domestic mandatory carbon market. So what is next? In the sense, we are discussing about a green hydrogen and how do we really create a pipeline about the green hydrogen. And demand aggregation is going to be critical. And we talked about a mandates and penalties. So Government of India amended the Energy Conservation Act in December 2022 to bring about this, and they created a very interesting provision called non-fossil fuel obligation, NFFO, in the particular scheme. What we saw actually is something totally different. The government came out with a regulation under the NFFO, and that NFFO, that regulation has been used to actually hijack RPO regulation under Electricity Act 2003. So there could have been a mandate for usage of hydrogen based on the type of industry or type of heat source that is being used by the industry, and on the so that they would have been forced to use the hydrogen. Unfortunately, that hasn't happened. And here, not only the government is to be blamed, but also the private sector is to be blamed because of the kind of information, the kind of data that is required, the kind of effort that even the local green hydrogen industry has to take, hasn't really taken. And if you see, the penalties under that particular provisions are huge. Okay, the penalty is in equivalent terms of more than 10,000 rupees per ton of oil equivalent. Now they have increased, proposed to increase to nearly double than that. So, as far as the legal provisions for creating mandates and penalties do exist, what is needed is that a lot of effort on the part of the government as well as the as far as the industry is required. I have another one more fundamental question, and I would really like some responses over here, is about this entire target of 5 million tons of green hydrogen and the focus on the export of green hydrogen and how it would be treated under the NDCs as well as the biennial compliance reports, or how it would be done into the carbon account of the country as a whole.
Focus on export is an after effect. It wasn't designed as the primary intention of the government, which brings back to our fundamental question: who's buying?
Exactly. but just to give, everybody who works in hydrogen, we know that our domestic demand is somewhere between, or expected to be somewhere between 5 million ton to 6 million.
It is.
Okay. So when we talk about a 5 million ton, everything is not going to move from green hydrogen, the gray hydrogen or whatever kind of color of hydrogen it is today, to green hydrogen immediately, or even in next 10 years.
So 95% is steel and refinery and fertilizers. Right? Everything else is 5%. Refinery, why should they have those points that start with that 5% because they are paying a higher price point, right?
They're already starting. No, Reliance is going to convert their refinery green. Similarly, steel is going to get into green. So these are the main places where
steel, I don't still understand. Refineries, they have got their local source of green hydrogen or hydrogen. They moving to the green hydrogen is steel. Refineries. Is still a bit of a question mark. But anyway, so my question is not on that, sir. Let's assume that everybody moves, or most of the people move. How it would be treated with respect to the indices which the government has given? That is, okay, 50% of the total capacity would be in renewable terms. Okay, given what all the PLI schemes and the kind of demand increase that we are seeing, whether the 450 gigawatt or 500 gigawatt would be sufficient, whether this 5 million ton or whatever is being exported, let's not talk about 5 million ton, whatever is being exported, 2 million tons, whether that would be on top of this 500 or on top of 50%, and how that entire accounting would take place, because I believe that would create a kind of risk for the project developers who are developing green hydrogen export projects or the port-based export projects on the entire accounting issue. So I think this is something I am trying to grapple. I hope there are some answers. I would love to hear those answers.
Question at the back.
So just to answer to it in some sense. So apart from the 50% renewable capacity, we are also committing to 45% cut in our 2005.
Yeah.
So, and sir mentioned, 95% of the hydrogen ecosystem is primary to the steel and the refineries. So if the government makes, or the ecosystem makes that switch, right, it's directly contributing to that 45% target that we're trying to achieve.
Correct. I agree. So that is another complication, what we are talking about.
Which is, suppose we export 2 million, we enter into India's and accounts of moving towards green. Could easily can be used to offset our non-green part, saying that we are contributing to the world so much, so that allows us to.
Sir, it will be other way around, sir. It will be other way around. That should be taken out of our. But also the other end of the spectrum is also true. So a lot of the credits that are being exported and just getting a $1 or $2 benefit, will be priced higher.
Absolutely, it has to be priced higher.
So
It has to be priced higher. It's a double accounting.
exactly.
So this initial 5 million tons, obviously, the government is not expecting India to consume the 5 million tons, right? So that's why export focuses come in. But 15 years later, if the price parity is there, I think government will start regulating exports of green hydrogen because we're using our renewable energy, resources to offset.
You're also bringing a significant revenue into that.
So that's covered in the Article 6, which I referred to. So, and that's what is to the IT.
That is G2G, right?
Yeah, G2G, but that G2G will benefit to the P2P transaction, right? Private to private.
Yeah,
Unless the G2G agreement is in place for the ITMO, because this NDC commitment then can be credited to that particular host country, which is the part of the global north. And that will help us to grow this market. Otherwise, there is no.
You cannot go wrong on green.
You cannot go wrong on green.
Right? So if you bet on green, you will get the benefit. Now the question is who funds it today, right? Is the FID going to happen today or not? And that's why we are here together. How do we get the FID to happen? So you have to accrue some value, and carbon exactly remains a question mark. And we say, okay, you will carry on accruing those credits. Right? That's another mechanism. So if the pricing today is $2 and then eventually move to a higher benefit, those benefits will eventually pass through, as he said, P2P, right? The sovereigns may be.
That's why it's not only about ammonia pricing, it's about this carbon pricing. That game is all about carbon pricing and ITMO, how do you price that ITMO? And that's where we need to think and discuss with those respective governments.
And those breakthroughs are, I think they're not far away, right? Because the pressure is building up. They're not far away. Challenge is the macro climate. So which is why we say, let's work on the low-hanging fruit. There's $1.5 trillion equivalent of institutional money within India. Let's all of us work together to unlock that money, right? Why do we always have to look at foreign capital? If you're looking at foreign capital, let's go to low-interest economies. Going to high-interest economies right now is dead on arrival, right? Absolutely dead on arrival. But work on the assumption that if we create an FX hedging layer, right, and that product will take a year, 18 months, 2 years to develop. And as soon as those economies come back to a lower interest rate environment, right? So, and I was speaking at a couple of forums, very interesting discussion with pension funds in Europe right now. They're saying we price everything on 5 to 6% return on dollar or euro, whatever the currency, right? With high interest rate environment, they're saying, well, we'll buy a UK government bond or a US bond. Why should I bother with a private sector asset which is more risky? So money has actually gone away from infrastructure assets, right? And if India rises up and steps up and says, look, we're giving you 8, 9, 10% return on the dollar, right? But what I'm saying, how do you you're already doing that, right? And most of these assets, they're all on 12, 13, 14% IRR projects, right? Take 5% off, that's your dollar return. So now the question is the FX risk, right? How do you price that FX risk? So we look at how do you price a private sector asset in India, a green hydrogen asset in India, and green hydrogen asset in Europe. So look at what is the country risk. we say 10-year Indian government money is at 7.5%, 10-year US money is at 3.5% or 4%. So the differential is a 3.5% differential. So that is your so-called country risk, right? So if money is available in US or UK at 3.5% to the project, money should be available to Indian assets at 6.5%. And why I'm saying 8%, I'm adding agency costs in the middle, right? So that is the kind of benchmark we are saying. But the biggest hit then is the FX. So we have to work on reducing the FX. And the moment you do that, money will start gushing to India automatically. We don't have to try hard. So the FX.
I think your first question, which is how to unlock the huge amount of idle deposits with all public sector banks, that is a bigger question.
So that's because the agencies require a AAA rated asset. Right? So there has to be a credit enhancement instrument or a structure.
So we did an analysis. I also look after capacity building commission. So we were doing basically training programs for public sector banks. One thing that we took up was, if India also has one of the world's best bank, and also India has some of the worst performing banks, then how they are working in the same regulatory system. So if you look at two indicators of ICCI and HDFC, that is the credit to deposit ratio and the non-performing asset ratio. So they both are like any global best. You look at even good banks like SBI and all, their credit to deposit ratio is so low. Most of the money is sitting idle with them. So the issue is not about regulation. The issue is about fear and risk-taking ability and managerial decision-making. So it's all this policy, I mean, just like this green sector, there are at least 100 other sectors which can just grow India into the next level if this sort of money was to flow with full risk-taking ability and complete shielding of mistakes. Just say that there is any small mistake.
If you see the report, the first thing we said is develop the risk register for the country, right? Because risk is not understood in this country. Risk is not even quantified in this country.
So one is risk, and the second is delinking personal decision making with personal penalties. Because people are not taking decision not for any big macro issues. We talk like this because we think that what we are talking at the government policy level matters to you personally or to me. Western people talk like that. What they're talking here and what they're doing in their office and their home, it's all integrated. It's not for us. So while we might talk like this, but the senior banker will say all this stuff. He goes on a file with which CBI guy is going to look into. That same day, he needs India needs for solar energy, go to hell, and he has not taken any responsibility. So this dealing is also, it's not his fault. It's the fault of our system. It's the fault of the press that they hound people like that out.
Which is why we say it's a first of a kind projects, no regret investments is what is needed.
No, but we need to change this. It's high time we start changing these types of things.
You have a point on how do you unlock? She's an expert on green bonds.
But I mean, I'd just like to highlight one thing here. So I'll introduce myself. I'm Ketan Kotak. I represent India International Exchange. We are in GIFT City. We were the first stock exchange to set up in GIFT City. As Sir started, with his details, where he said that 10 years back, where green, we didn't know what green. So 5 years back, when we started GIFT, nobody knew what GIFT was. So today, we have almost 14 billion of green bonds established, listed on our platform. We've come like a really long way from there. When we started, people used to say, "वो तो मतलब क्या गिफ्ट में आके क्या करते हो? 3 शेयर वाला मुंह देख के आप पेपर लेके आते हो, हमको आना पड़ता है आपके पास." It was like that kind of a scenario. But today, we have a unified regulator there, IFSCA, which has been given the powers of 11 other regulatory bodies. IFSCA has come up with so many different thoughts, processes, ideas on mobilizing capital flows through, for especially for ESG. As Honorable FM and PM have a vision that, IFSC should be the hub for ESG and all these kind of products for financing as well. What I see, even in the forum here, other than Vishwajit ji talking about IFSC, we completely missed the point. We are talking about bank financing. How many of us here know that the ITUs and finance companies in IFSC have been mandated? It's compulsory for each one of them that at least 5% of their incremental loans have to be disbursed towards green, social, sustainable, etc. Only 700 million out of that has been disbursed so far. Now, do we say that it's the fault of the banks? No, not really. It's a demand supply thing. It's a knowledge thing. So many people don't know. I've been actually making pointers. There are so many aspects that we spoke of in terms of DFIs. We had a sustainable committee set up in IFSC, which was chaired by Mr. C.K. Mishra from the government. We had beautiful discussions over months, and there were so many suggestions, so many thoughts, so many ideas that came up, like, setting up of a pooled vehicle in IFSC, the likes of a NABARD or an L&T or something. A company would set up a pooled vehicle where, small loans don't have to, the cost, the time, the effort, those kind of thoughts, those kind of ideas came up. Now, our exchange itself has a tie-up with Luxembourg Stock Exchange, where under the aegis of the Finance Ministry, we have an MOU with Luxembourg, where any instrument listed on our exchange gets a green corridor to Luxembourg. What is the benefit, you would ask? The benefit is that all the European investors there have visibility to this bond, to this instrument, to this new product, which otherwise would really be suffering, lingering somewhere. 100 million raise kar liya, 100 million ka loan mil gaya usko, or then it's the end of the story. But here that visibility is there. The DFI piece which you spoke, very important, very crucial. IFSC can play a huge role in that. That was another thing which we spoke of in the sustainable committee discussions. That, if an agency such as yours could approach, or, just a thought. IFSC definitely has a lot of MOUs with IFC, World Bank, ADB. In fact, IFC bonds have been listed on our exchange. They chose to singularly list them on our exchange as a support to gift IFSC, to promote, to bring about visibility to IFSC. So there is so much so that there can be done for this particular, I'm no expert in green hydrogen, but financing, as we're all saying, sir, that there is a lot of demand supply gap, lot of availability, lot of possibilities, and I think it's a sector.
So that is part of the efficiency of the system to educate all stakeholders also. Right? So what I'm saying is we don't need to create the transition money is available today to us now.
Yeah.
Right? If we become efficient in our ability to tap into those pools, we don't need to wait for the market to develop. That money is available today. Right? But the devil's in the detail is creating those new products, right? And those structures. And so I've had discussions with
baby steps.
Yeah, baby steps. So
the loan portion, baby steps.
When IFSC visited London, we did a that's when the dialogue of how does India, which is the largest aviation market, right, start to bring the financing hub from Dublin to IFSC. Right?
Correct.
Right. That was the discussion in London, and we also presented to them that let's mobilize. There's enough capital requirement in this room alone. Right. The 5 or 6 developers alone need 10, 15, 20 billion dollars by Monday. Right. How do you unlock that? So that's the first invite on Gift City Exchange, right? That taps into that international money. So I think what I'm saying is there's a new sort of category of people who are help in the transition economics. That's what's needed.
Correct.
Right? And as Mr. Pradeshi said, that there's inefficient money locked up in the system.
Correct.
So that I would go target the 1.5 trillion immediately. That's sitting in the Indian institutional money managers, right? So why are they not investing? I think the role of the law firms, the role of risk management agencies or risk pricing agencies, the so-called rating agencies. I think we've not put in enough effort to bring rating agencies to the table, right? So let's look at those aspects. The point well taken. This gentleman had a question.
My name is Vishal and I'm a technology and product developer especially in the sustainability area of green hydrogen actually. And I see as a government, how the government become a facilitator as, I'm part of many G20 meetings and I meet this institution in several times now, just such a big conference actually. So I become part of this group and it's really my privilege to connect with this business development group. So I see the area of, there are a lot of investment available. When we create some solution, we show the solution proof. How we see the, I created my individual capacity, my engine investment in a COVID time, created the hydrogen, concentrator. I solved the problem of many, this is about the chest area. Now we go forward about how we can create the, airship using the hydrogen, because we see about the where area there is something we create out of the box, solution. We want to connect because the Indian market should be create out of the box solution where we can, have big economic increase. So I want that I given some of my paper. I meet the defense thing, 1 week back actually. Let's say I want the government role as a facilitator so we can create ecosystem, how we can drive, impact actually. At the last mile people, we can create impact because our country need of help at the logistics area, transportation, and how we solve the problem where we can supply the energy to people who cannot access the energy actually, right in fact. So I wish that how this ecosystem get integrated together and government become a facilitator actually to the validation about any solution actually. Thank you so much.
Any final sort of points, comments?
We've been discussing so much about decarbonization, sustainability. The important parameter is to really set the expectation in terms of, what investors really look at. There are bigger companies like Avra and the balance sheets have been created. But if you keep return expectations of 18-20% on equity, this industry sustainability cannot happen. So important parameter is set your benchmark, have year-wise targets in terms of what can be achieved.
The promoter, then why will they come into?
No, that's get funded from the government side. In some way, subsidy can come in or whatever. But please understand this. I mean, unless government supports this, if US government can give a $370 billion subsidy, India giving a PLI scheme of 1 lakh crore is not going to be sufficient. The subsidy has to be
announcing that subsidy. Yes, giving and announcing is
so the ROE expectations are typically on the higher side, which needs to be really, brought it down in a structured way, and then can go up in a way which can.
I'll refer on that 18-20% return expectation is again commensurate to the risk in the system. Right?
Let me
pricing of money, whether it's debt or equity, is a function of risk.
Yeah. Right. And bigger, like these two companies, the balance sheets are already created. So it's easier for any investor to look at and say, okay, I will finance. It is not.
We understand that issue, right?
Can we just get into this issue, please? I think I'm going for it.
So, no, because all the financing that's happening is happening for the AAA rated companies or the big companies with balance sheets, right? So unless the mid-tier companies come into, getting these
I recently did one analysis just from the point of view of understanding things. BRR to BRSR. BRR started in 2012-13. Now we have come to BRSR. So what has been the impact of market capitalization then and now? If you take 3 companies which I studied actually, if you look at Reliance, market cap that time was say $50 billion. Today it is $250 billion. You look at Hindustan Lever, you look at Infosys. So these 3 companies which I studied, I'm studying a few more companies. But the impact of investment in sustainability, which typically demands a 20% sort of an ROE, has been 50% average return on investment on a year-to-year basis. If you look at the incremental market cap. So that's the point which I want to drive, that if you're really worried about investing, you should worry about doing clear-cut strategic investments, and too much of large PE investment can probably happen in bigger companies. It cannot happen in smaller companies and smaller ventures. And that is something which needs to be looked at. All major strategic investments will benefit those corporates immensely in the coming years.
Which is why if you look at the financing continuum, right? Yeah. Bigger companies are at the other end of the spectrum. Small, so there is a different category of PE investor for smaller companies. right? So that is what I'm
I
saying.
worked on few transactions and, for some or the other reason, those transactions failed. Only reason was expectations are so high because this is transition. Transition cannot happen in say 6 months, 1 year, 2 years.
No, transition economics is different. Right? So that's what I'm saying. If you view it from
These
a
are the
lens,
challenges which needs to be addressed.
view it from a lens of steady state economics is different. This is a new asset class that has to be created, which is transition, right? Transition from small to big, transition from old energy to new energy.
That's why government has to have a much bigger role, which will probably meet the expectations of some equity return.
Chandra, as an organization, this is what we are also looking to focus on, right? Even so, the likes of DFC will come in here, right? They are ready to look at smaller projects where bigger banks are not ready to invest.
Yeah.
Another meeting in Mumbai just about 8 months ago, there was all the Indian bankers there. I asked who's invested in the green hydrogen project. Not one hand was up. No ICICI.
They're not looking for the battery. Also, the event we had in Delhi.
Yes.
Where Prasad was there. They're talking to bankers. I mean, he said very clearly they're talking to bankers. The bankers are not coming forward even for batteries.
Exactly.
So there's a question of
And you can't expect them to also. No. Or you create a guarantee instrument. Create a guarantee instrument. Then you see there'll be queue from here to Timbuktu of all the bankers. Right?
So under this program, these are all the things we're looking to address. How can we create these guarantee instruments? Who can come and do that? Once that is done, how can we unlock more financing? How can we bring more project financing?
Government's role is not to throw more money. Government's role is to create more confidence. The more confidence you create in the system, the risk reduces. And if the risk reduces, there will be more money. Right? That is what.
Yeah, in fact, for the solar sector, the government had created such a revolving fund, 543 crores when the National Solar Mission phase one.
So we have those precedents. We have those precedents available. NHAI, when he said, look, I now there is enough track record in the process that I'll issue a bond open for retail investors. Right? Why should I borrow money at a higher cost when right? So there is money in the system. Let's find the right structure and the right instrument. That is what is missing. Right? The instruments are missing.
Maybe we need to probably move towards a revenue-based revenue sharing sort of mechanism.
Whatever. Yeah, right? That's past. That's again risk sharing. No?
Otherwise, see how will
At the end of the day, from the government perspective also, there is a guarantee, there is some kind of assurance, but it has to be limited. The revenue sharing where, it takes into the realm of, uncertainty, both for the developers as well as for the government.
Structures have to be back-ended, front-ended, whatever, but those kind of things we need to create. Otherwise, mechanism will.
But look, there are. That's why I'm saying this forum that's being created. Put your project ideas to us. Leave the financing structuring. Right? We'll do the financial structuring because you guys are the implementation guys, right? And we are the financial structuring. So put your ideas to the table. I'll bring out those marvels, right?
And just to share with everybody, in Punjab we did financing many years ago, and we actually got the first escrow on the state collection account. So that is something which where State Bank of Patiala was involved, and we actually managed to convince them to get the first charge on the entire state receivable. So these kind of structures could help actually.
Chandra, thank you very much. If there's anyone online who wants to ask us any questions, you can on your cameras and mics. But we'll be closing in shortly. I know we've gone 1 hour over schedule. All the questions in the chat box, we will address them slowly.
We'll do it offline. I don't think we have the time. So on that note, thank you very much for everyone, both in this room and online. We'll have a quick group photograph before you guys disappear. And for those who haven't received the report, you'll get a copy of that on Monday. And we'll send instructions on how can you share your project ideas with us, and we'll start working on that together. Final words to Nish and Anjan.
So if we can have Mr. Anand Desai, who's a managing partner here at DSK. Thank you very much for having us here at the office. You can say a few words, please.
Well, I got it for the last 1 hour. I was fascinated. I don't understand the subject much, but I would like to understand more when we're talking more content about this. But we love to participate with all of you and see if we can help in any ways.
Wonderful. Thank you, sir.
Thank you very much.